City. I'm Shauna Smith alongside Brad Smith, and this is Yahoo Finance's flagship show, The Morning Brief.
Good morning, everyone. Stock futures are in the red after a whipsaw week. We'll see if stocks can recover ground ahead of the opening bell. We got about 30 minutes till that point, so let's get to it. The three things that you need to know to start your trading day. Yahoo Finance's Jared Blickery, Madison Mills, and Josh Lipton have more.
Futures are moving lower 30 minutes ahead of the opening bell. Monday saw the worst rout of the year, while Thursday, reassuring econ data helped the S&P earn its best day since late 22. Now, the sell-off hitting Nvidia hard, the chip maker shedding more than $900 billion in market cap at one point this week over fears that the AI trade has run out of steam and growing concerns over the U.S. economy. But even after the volatile week, the S&P 500 is currently on track to close down.
And Bitcoin extending its gains from Thursday. Bitcoin now pushing past 60,000. Those moves coming after a volatile week for the cryptocurrency, and that took the price of Bitcoin below 50,000 at the start of the trading week. Now, some investors calling the quick reversal in recent price dip a bear trap, but Bitcoin is up more than 5% on the week. Still on pace, though, for weekly losses.
And Fed Chair Jay Powell is under pressure over the central bank's path forward. A key non-voting member claims Powell is not ready to support rate cuts just yet. And meanwhile, former President Donald Trump is bashing the central bank over the Fed's decision making. Trump is now calling for involvement in future decisions, saying the Fed has, quote, gotten it wrong a lot and that he has better instincts in many cases.
Well, futures right below the flat line here. You've got the Dow futures looking like it's set to open off just around 100 points. The S&P 500 coming off its biggest one-day gain that we've seen since 2022. And this comes just days after the index had its biggest one-day plunge in nearly 2 years on Monday. Following jobless claims triggering a relief rally yesterday, helping to easing some fears surrounding a recession. So here with more, we want to bring in Daryl Cronk. He is Wells Fargo's Chief Investment Officer for Wealth and Investment Management. Daryl, it's great to have you here on set. So it certainly has been a wild ride, to say the least, for the markets this week. Where are we in all of this?
So fortunately, we're kind of back in this soft landing camp, right? I mean, I think if you look at key threshold levels, I call it the 3, 4, 5, right? You need to be below 3.5% on the 10-year Treasury. You need to basically be above 400 basis points on high yield spreads, and you need to be below 5,000 on the S&P before you have kind of a problem with hard landing data throwing it in there. It has been crazy, though. The VIX on Monday had the single biggest spike it's ever seen intraday in its history, followed by the biggest drop on Tuesday since 1990. So I think investors are a little bit on a hairpin. Yesterday's jobless claims number, which is usually a muted point, shows we got a 680 point Dow rally off of weekly jobless claims, which candidly came in 7,000 less than expectation. The expectation was 240, it came in at 233. That should have been a non-event, and everybody said, oh, now we're back in the soft landing camp. It was a little bit crazy, right? I mean, the investors are on a hairpin right here.
On a hairpin, but it still seems like they're identifying where there might be buying opportunities, as referenced or as evidenced through our conversation with the Robinhood CEO, Vlad Tenev, who said on their platform, they saw some very strategic positions being entered into by their traders right now. So on a hairpin, but it seems like there's some opportunistic buying right now.
I think that's right, Brad. And in fact, we moved a bunch of capital around earlier this week. We actually added back to, we had been underweight small caps for the better part of 2 years because large has just continued to outperform small by a huge margin. We brought that back up because we thought the Russell 2000 came down to a level that was, more or less a fair risk reward trade again. It wasn't off of the July big rally when it was all PE expansion. We also added some money back to high yield because high yield spreads went up to 380 basis points. That's the high point of the year, right? The widest spreads, which means the cheapest entry opportunity of the year. So we took that as an opportunity to do that. We also just think that investors need to get out on the curve a little bit from a duration standpoint on fixed income. They've been crowded, as everybody knows, to the short side of the curve, highest yields on the board. Everybody just wants to roll one-year Treasury bills. And if the Fed's truly going to lower interest rates as much as people say they're going to, right, and we think they will, You can't live there with that reinvestment risk on the short side of the curve. You need to get out and lock in some of these longer term rates.
Daryl, how dependent is all this on the Fed cutting in September? And how much does it really matter if they cut by 25 versus 50, which obviously has been gaining a little bit more popularity?
Well, I think the 50 needs to be the base case at this point. I said to...
Why is that?
Because I think they're actually behind the curve a little bit here. I think they do need to play catch up with the lag effect of monetary policy. I mean, earlier this week, we were pricing in the Fed funds futures were pricing in 140 basis points of Fed rate cuts this year. That's 5 to 6 rate cuts this year, which would mean 50 in September, 50 in November, and at least 25 in December, right? That's too aggressive. That's a hard landing scenario. But I was telling my team earlier this week, when I wake up in the morning this past week, the two things I get my eyes on, very first, the yen, right? Obviously with what happened, and the 2-year treasury. Because the 2-year treasury is the only Fed speaker that matters, Sienna. It's not Chair Powell, it's not the presidents and the governors. What the 2-year treasury tells you is where Fed funds need to be.
And so with that in mind, and you mentioned some of the positions that you were kind of nibbling at earlier on this week and reallocating towards a little bit more. Where does that set up for the rest of the year here as we're kind of thinking about, okay, we're wrapping up this second quarter earnings season, and then eventually once we get into the late throes of September, early throes of October, we'll start to get some of the consumer names that are going to report earnings to end out this earnings season, and then we get into the refreshed earnings season. What is the consumer going to spell out about the economy that will also govern where this market moves?
So it's the great question, Brad, because the consumer is the linchpin here to whether we soft land, hard land, no land, whatever scenario you want to say. Good news, bad news. Good news is, Q2 earnings season's winding down, revenue's growing 5%, earnings growing about 11%. That's the best earnings season we've had since Q3 of 21. That's a great earnings season. We'll take it, right? Because all we've gotten is PE expansion. On the consumer side specifically, though, not such good news, right? I mean, if you look at companies that reported in the autos section, the retailer section, certainly the airlines, which we know, right? All of them disappointed, all of them more or less lowered guidance into the back half of the year. So I do think it's going to be a choppy back half of the year. It's very unusual when you get a market correction with poor seasonality, which we're heading into, to put your lows in August, right? They almost always come in September, October, on that seasonality element. So I'd be surprised if what we just put in this past week in, let's call it early August, are your final durable lows. I think you've got to test and retest and consolidate here for a while, and probably mean some more downside.
Interesting. Daryl Cronk, who is the Wells Fargo Chief Investment Officer for Wealth Investment Management, joining us here in studio. Thanks so much. Joining us here on a Friday. I mean, not a lot of people still making their way into office on a Friday. You came to a different office on a Friday.
I love to come in on Fridays. The quietest day of the week.
It is. Daryl, thanks so much. Appreciate
My
it.
pleasure.
Chips reversing some of the gains that we saw earlier this morning. Nvidia, interesting, leading up about 0.4% right now and clawing back some of the losses after the chip maker shed more than $56 billion in market cap this week. And so taking a look at the shares right now, fractionally higher, you did have a little bit of a bullish call that came through, at least in upping their price target. Mizuho did earlier this morning, and so we'll see if that has any outsized effect on that. Mizuho raising their price target to $132 from $127.50. But I think going forward from here, the larger question is, as we are still a couple weeks away from those Nvidia earnings and whether or not that is going to be the bellwether that it's been in the past earnings season, if this company continues to signal that, hey, AI demand is still rip-roaring to the upside and there's so much demand that could actually broaden out to the rest of this chip sector too.
Yeah, certainly. And I think when you take a look at some of the optimism, at least that we're seeing for NVIDIA here this morning, some of that being tied to the July results that we got here from TSMC and the fact that that obviously serves as a bellwether here for the AI industry, what exactly demand could look like going forward. So the move here to the upside coming on the back of yesterday's rally. And I think if you take a step back, part of the reason why we're seeing so much volatility in Nvidia specifically is almost a lack of catalysts that we're likely going to see between now and when they report earnings. Because you and I have talked to so many analysts over the last couple of weeks talking about the fact that, yes, there is still reason to remain bullish on Nvidia in the long run. There's lots to like when you take a look at the demand picture, how dominant they are within the AI chip space. But when you take a look at between now and the end of the month, there's not likely a heck of a lot of catalysts, at least at this point, that's laid out on the calendar that we could see here for Nvidia. So because of that, many of them advising that we could be in a volatile type of period here over the next couple of weeks. But again, looking further out, I think consensus has very much been that there is strong reason that investors should be using or can be using, this is the advice that we've gotten from analysts and even some strategists here on Yahoo Finance, that many investors should maybe be using this as a reason to buy. And I think we have seen some evidence of that, at least some of these days here this week.
All right, we'll see. IDC projecting generative AI spending to reach $26 billion by 2027. We'll see what part of the market share Nvidia can hold on to leading up to that point. We got some time.
Got some time.
All right, turning to the presidential election. I forgot this is my read. Turning to the presidential election here. Former President Trump saying at a press conference in Florida that the president should have more say in the Federal Reserve's decision-making when it comes to interest rates.
I feel the president should have at least say in there. Yeah, I feel that strongly. I think that in my case, I made a lot of money. I was very successful, and I think I have a better instinct than, in many cases, people that would be on the Federal Reserve or the chairman.
So what could this mean for the central bank moving forward? Yahoo Finance's senior columnist Rick Newman joins us with more. Rick, help us make sense of this.
The concept fills me with dread. I don't know about anybody else, but it sounds frankly like a terrible idea to let the president have more say in the what the Federal Reserve decides. President Richard Nixon back in the early 1970s actually did influence what his central bank chair did at the time, and it was disastrous. It made inflation much worse because Nixon wanted much the same as Donald Trump would probably want if he wanted president, which is he wanted a central bank policy that would boost employment, and he didn't care about inflation. And guess what happened? Inflation dominated the 1970s. So, Trump said there he made a lot of money, so he's a businessman. He ought to know. Well, guess what? Donald Trump actually started with a business that his father built. He didn't build the business. And Donald Trump has declared corporate bankruptcy 6 times. I mean, try to find some business person who has 6 bankruptcies on his or her record. Very hard to find. So, no, I don't think anybody who follows markets wants Donald Trump to be running the Federal Reserve.
Rick, the former president, also saying that he's agreed to 3 debates with Vice President Kamala Harris, also the Democratic nominee at this point. So what do we know about this, when the debates will actually happen? I mean, that's what he's agreed to, and that's what's been proposed as well.
Right.
I think it's only one that's actually been secured at this juncture.
That's right. So when Joe Biden was the candidate, they had agreed on 2 debates. One was the one on June 27th, which was the beginning of the end of Joe Biden's candidacy. And then the other one that they had already agreed on was on ABC on September 10th. So when Harris became the candidate, Trump kind of said, oh, now I'm not sure about the debates. And it sounded like he was not willing to debate Kamala Harris. But what he said yesterday is he put this 3 debate thing out there. But the one that has now been confirmed is the one that had already been confirmed, which is September 10th on ABC. Trump has proposed 2 other debates, and the Harris campaign has not yet said whether they will agree to those or not. So we're going to have at least one debate between Donald Trump and Kamala Harris.
All right. Rick, thanks so much. We will see what the viewership looks like for that one. Appreciate it. Well, Bitcoin is up more than 5% as investors look to regain some ground from this week's sell-off. Some traders believe the quick reversal suggests the recent price drop may have been a bear trap. Yahoo Finance markets and data editor Jared Blickery is tracking those recent swings. Jared.
Brad, Bitcoin is basically a trap. Let's check out the price action this week. It's been very volatile. This is actually a 3-month look, and you can see we just had this dip all the way down to about 48,000 there. And for me, 60,000 has been the important level to watch. And I'm going to zoom out here. I'm going to put a year-to-date chart on here, and here's the 60,000 level. We've dipped below it once, twice. And this is a 3rd time, each time going a little bit below, but then climbing back above 60,000. These are all false breakdowns. You can can call them bear traps, and it costs traders a lot of money and peace of mind. But nevertheless, that's what's happening. But another way to look at it, it's just in a little bit of a flag here from a sustained up move. That's a 1-year look, and it's even more apparent on the 5-year. So this is just a tiny little flag here in the grand scheme of things, but it's painful on a day-to-day basis. Now, when I was watching, I've been following fund flows as well. We have all these new spot Bitcoin ETFs, and not only Bitcoin, but Ether. And we've seen some really positive movements this week. I think overall, the sector was lost about $250 million or $250 billion. But when you take into consideration that a lot of that was out of the grayscale entities, you get a positive net flow for Bitcoin. So I think it's positive that we have, in the midst of all this turmoil, we still have a lot of institutional and retail interest in these funds. Guys?
All right, Jared, thanks so much for breaking the movement down that we're seeing here for crypto as we wrap up what has been a volatile week for almost everything across the board. Let's take a look at Paramount because shares moving to the upside here this morning. The company reporting a profit within its streaming division for the first time, but there's weakness in its linear TV business. Lots of questions about maybe what this signals, some trouble here for this sector-wise. We're going to have analyst reaction when we come back.
Shares of Paramount are moving higher after reporting a profit within its streaming division for the first time. The company also announced plans to lay off 15% of its U.S. workforce in an effort to cut costs ahead of its merger with Skydance Media. For a deeper dive here into the latest quarter, we're joined by Jason Bazinet, who is the Citi Managing Director. Jason, great to grab some time with you here. I mean, as we're really kind of diving into what we're seeing in the streaming landscape, where is Paramount trying to position itself, and where do these results kind of lay out the reality of where it actually is?
Well, I think the themes we've seen have been pretty consistent across the space, which is better streaming profits, but that's come with larger linear losses. And so the trade-off that the street's looking at in aggregate across these companies, isn't super bullish. The one thing that I would say that we keep looking at is not so much the net ads or the profits. What I keep focusing on is what is the consumer paying to spend an hour on any one of these apps. That is the most important thing, because what it tells you is, are these being viewed as really linear pay TV substitutes or not? And there's very stark differences across the streaming landscape.
Jason, when you take a look at these results here, there was a lot to be encouraged about. But then when you take a look at some of that weakness, obviously Paramount writing down the value of its cable TV business by about $6 billion. This comes on the heels of what we saw from Warner Brothers Discovery earlier this week. My question is, why do you think we're seeing this now? Should we be reading into the timing at all?
Why are you seeing it now? We don't know the specific tests that they're doing to go through these impairments, but I think what we do know is that all of these companies went through mergers, right, a couple of years back, and so you had to sort of assign goodwill, right, based on the equity values at the time that those mergers occurred. So I don't view the write-downs as being particularly meaningful because the street is reacting in real time and adjusting the equity value. This is sort of a backward-looking lagging indicator on some goodwill asset that sits on the balance sheet that's sort of irrelevant. Having said that, I mean, what are the impairment tests that they're doing? They're looking at what is the trajectory of the linear business, what is the both on advertising and affiliate, and those trends aren't good. And so I'm sure the write-downs are absolutely appropriate, but not something that should really bother the street because each quarter they're adjusting to the real-time trends.
Is it something in the write-down that you, for Warner Brothers Discovery, might attribute to the loss of the NBA, and then similarly for Paramount, attribute it to the Skydance deal even?
No. Well, Skydance for sure, no. On the Warner Brothers side, there's no doubt if they do end up losing the NBA, there would be some diminution to the value of the linear business. But they're caught up in litigation, so I don't think that they would inject the NBA contract, into their forward commentary until we have legal clarity on where those NBA rights are ultimately going to land. So I think that the short answer is no and no.
Jason, when you take a look at the fact that we did see a turn in profit for the streaming business for the first time, how encouraging is this? Is this something that you think you're confident, and maybe it's way too early to tell, but that this is going to be the start of a longer trend?
Oh, I think it is. I think it is for sure. I mean, what's happening underneath the covers that we don't see is these media companies are going in and negotiating with advertisers. And the advertisers are saying, oh, I don't want to buy as much of your linear time. I'd like to buy more of your streaming time. And so this is sort of, you squeeze one end of the balloon, right? And the same thing is happening on the affiliate side. They're going and negotiating with the distributors and they're saying, hey, can you give me a little bit of relief on the linear affiliate fee, but I'll pay you a higher wholesale price, right? So the trends are positive. They're going to continue, but I think the street appropriately has to look at the composite picture because some of these dollars are fungible across the two divisions.
All right, Jason Bazinet, always great to get your insight, especially on a day like today. Citi's Managing Director, thanks so much. Taiwan Semiconductor shares are moving higher after its sales grew 45% in July. That's up from just about a year ago. The sales boost raising investor hopes on demand for AI chips. And like we said earlier in the program, this is often viewed as a bellwether here for AI demand. So that's a reason why we're seeing obviously optimism play out on Taiwan Semiconductor today, but also when you take a look at Nvidia, AMD, some of the other chip makers there heavily involved with the AI space are also getting a bit of a boost. So it's helping to drive that sentiment here across the board. And remember that this is a supplier here for Nvidia, for AMD. It's a sole supplier of processors for Apple's iPhone. So again, just distracting some of that demand. What we're seeing here for Taiwan Semiconductor obviously sets up a more bullish case here. We're talking about lack of catalyst. Maybe this is a small catalyst here for Nvidia, at least in the short term.
You talk about a company that definitely hopes that I upgrade from my iPhone 12 Pro Max.
You're not helping them
at the end of the day. I am not helping out, but they're hoping that in this upgrade cycle come September that I will be one of the catalysts or contributors for them continuing to strengthen their relationship with Apple. All that aside here, and we'll see if I upgrade. I'll report back on that. Q3 revenue is projected to grow 37% here. There also might be some price hikes that are set to come forth here, and that is to be expected when you have this type of demand profile and the resources are really being tapped across the board for Taiwan Semi. You get to pick and choose who you want to work with. You also get to pick and choose what the price is. And it seems like they're going to lean into that. Also, as a part of the broader revenue projection growth that analysts are expecting out there, it sounds like high performance compute is really expected to be the largest leader within this, in this continued performance here. That accounted for 52% of TSMC's revenue last quarter, and I believe first time that it's accounted for more than half of that as well here.
Good. We're looking at gains here across the board. So some optimism as we wrap up what has been a troublesome week, challenging week for investors.
It's been
out
rough.
there.
Let's just be real.
It's been rough. All right, well, let's continue with this move to the upside that we're seeing. Take a look at shares of Expedia because it's moving higher this morning, up just about 11%. The company's second quarter profit coming in higher than what the street had been expecting. And this comes despite issuing a bit of a warning, though, on demand. The company CEO saying in a statement that they have seen a, quote, softening in travel demand and are therefore adjusting their expectations for the remainder of the year. So maybe it's not as rosy as it initially looks at first take here. But again, you're looking at a pop in the pre-market. You're looking at 3-month gains of just about 5%. Remember that this is a stock that also closed the day up yesterday, up just about 4%. So it has benefited here from the sustained rise that we have seen in international travel. We have seen some destinations here, Middle East, Europe, a bit of a standout point here for the company. But they do expect that demand to taper off. They talk about high borrowing costs. They talk about sticky inflation from a global perspective weighing on consumer spending. So it's something that they wouldn't be surprised and maybe to an extent expect to weigh on the company's results here in the second half of the year.
Yeah, to your point, the environment healthy in the second quarter, as they say, but like the last few quarters, stronger demand internationally relative to the U.S. I wonder how many of those trips were booked for Paris, as everybody is taking in the Olympics this year. But one of the other huge things that we've seen is it's not all European travel. As Delta had told us earlier in the earnings season, that's actually a lot of LATAM travel that's taking place and being executed. Also, one of the things that we've heard over the course of this week, Airbnb pointing out that there's kind of a little bit less of a lead time that people are booking these trips with, perhaps waiting for deals or waiting for some of the prices to drop or just monitoring prices till it becomes a little bit more clear about whether or not they want to actually take the trip. So booking closer to the trip, I imagine something that is impacting some of the other booking companies here, especially Expedia, as we're discussing these earnings. And as we were taking a look at shares here just a moment ago, I'm taking a look at the year to date. And as of right now, year to date, still heavy declines for the company. Really sensing right now, trying to figure out, for investors at least, where they're going to see some of these tough comparables, especially if you look back to the revenge travel that was taking place in 2023, where some of those bookings are set to reemerge, what's going to be the catalyst for that.
Yeah, exactly. And I think when you're trying to figure out the extent of these gains right now, remember it was also a stock that had been beaten up as we saw Airbnb disappoint and also booking. So again, moving to the upside here. Just minutes away from the opening bell. We'll be right back.
Oh yeah, you hear the bell ringing, you know what time it is. Wow, they got the clapping, the cheering, and the dancing taking place at the NASDAQ. My gosh, vibes. Let's go. Who needs a vibe check when you see it there on the screen? And then at the New York Stock Exchange, people clapping. You've got to look at the Bunsen Group ringing the opening bell at the NYSE, and man, the vibes are just flowing at the NASDAQ right now. I can't even see the logo behind them to know who's ringing the opening bell. We'll check back in on that and circle back for you. Let's take a quick look at the major averages here to see where we open up the day. Right now, not looking great here. Perhaps we can cheer it and will our way into some gains to end the week, but we don't want to end the week the way we started. Hopefully. The Dow right now is down by about 0.25%, S&P 500 down 0.1%, NASDAQ down by about 0.2% right now.
All right, let's kick it over to Jared Blicker, who's standing by with a closer look at some of that downward pressure that we're seeing as we wrap up what's been a wild week. Jared.
I would love to be able to will us to some gains for the week, but I don't have that kind of power over time and space. So let's take a look at what's happening here. Over the last 5 days, S&P 500 is down 0.6%. That's not a lot. That's not even 1%. That's just a fraction of what it was down earlier in the week. And let's take a look at the NASDAQ as well. You can see that's underwater by 83 basis points, but not far from the flat line here. And then we'll take a look at the Dow, down about 1%, and the Russell 2000, small caps, down about 1% as well. I want to get a check on the VIX, which has been really active lately, but we're seeing it below 25 right now. Here's that big spike, actually got up to 65 on an intraday basis, third biggest spike ever. So we want to keep tabs on that. And let's just go to some of our heat maps here and check out the sector action. Now today it looks like real estate and healthcare are in the green. Tech is now in the green. Tech was one of the laggards coming into the bell here. Utilities is the biggest laggard. That's trading about 0.5% to the downside. And if we take a look at some of the leaders here, the IPO ETF is leading the pack. Haven't seen that happen in a while. New York FANG, so those mega caps doing well. Looks like transportation, gambling, value, solar, Bitcoin, all those are doing well. So I'll leave it at that. Not a terrible week. It's gotten a lot better over the last few days.
Certainly has. The narrative has shifted compared to what we were talking about on Monday morning. All right, Jared, thanks so much. Well, the S&P 500 is still on track for its fourth straight weekly loss in a row. Now, that would be the longest losing streak in almost a year. And this comes as investors do stay cautious following this week's massive surge in volatility. Here to discuss, we want to bring in Ed Yardeni. He's the president of Yardeni Research. Ed, it's great to see you again. So we last spoke on Monday morning when it looked like things were falling apart. Yet you told us at that time, you said, don't panic. The unwind should, quote, be over by the end of the week. So here we are at the end of the week. It looks like you were right, but what should investors now be anticipating that we'll see?
Well, yeah, my point at the beginning of the week was that it's too late to panic, that much of what we saw was a short covering situation vis-a-vis the yen, the so-called carry trade, where traders had borrowed a lot of money at zero interest rates in Japan, and then converted that either into other currencies and bought something like maybe the Magnificent Seven. And so all that trade kind of cratered, and the Bank of Japan came in pretty rapidly and said, you know what, we're going to not be raising rates here as aggressively as we had signaled. And so that calmed everything down. A lot of this was centered in Japan. Looking ahead here, I think we're going to see the market continue to churn below the July 16th high. So I think that the churn will probably continue through September, October, until the November elections. So I expect the market to kind of go sideways with a lot of volatility below that July 16th high. And then I think we could very well have a year-end rally, a Santa Claus rally, as people become more confident that the economy is resilient and it might do well no matter who's in the White House.
Ed, a churn lower, even if we do see a 25 or 50 basis point rate cut, which would initiate the beginning of the cutting cycle?
Mm-hmm. Well, look, I think when we were in the midst of that panic on Friday of last week and Monday of this week, there was some people calling for an emergency rate cut, some as much as 75 basis points, others saying that, well, you know, instead of 25 basis points in September, the Fed should do 50 basis points. All that, by the way, would have exacerbated the carry trade unwind because it would have actually strengthened the yen and weakened the dollar, which is a major cause of the unwind. So I'm glad that a lot of that hysteria is probably behind us. And why is that? Well, the data, the latest batch of data we've had has been pretty good. The purchasing managers for non-manufacturing was pretty good. Initial claims was good. The economy's doing fine. So I don't think that, believe it or not, I don't think the economy needs a rate cut at all. But I bow to the will of the Fed, and they I think will deliver 25, not 50 in September.
And I guess my question is, when you take a look at the market's reaction, especially to jobless claims yesterday, you had this big rally, the S&P having the best day that we've seen since 2022. And this all comes while the market is still pricing in larger than usual rate cuts here for September and for the remainder of the year. It doesn't seem like both of those positions can be correct. Can they? Am I missing something?
Well, I think you're right. It's either or. Either the economy is weak and the Fed's going to have to deliver more rate cuts, and then there is this notion that sometimes you get the market going down when the Fed first starts cutting rates. But a lot of that has to do with the history of the credit cycle. In the past, the Fed started lowering interest rates in response to a credit crisis. This time around, so far, we haven't really had a credit crisis. We had one last year, but the Fed dealt with it really pretty rapidly. So I'm thinking that, in terms of, we have two choices here. Either the economy is better than expected and we get only 25 basis points, or the economy is worse than expected and we get 50 basis points. I picked door number one. I think the economy is fine.
Ed, when we were speaking with a few money managers and strategists over the course of this week, there was the anticipation and then the action that they were noticing of some investors to still say, okay, we're going to open some new positions because we did see attractive, or relative to a few weeks back, attractive levels for some very highly valued stocks. Where do you think we'll continue to see that if there is more slippage?
Well, I think that we did start to see the market broaden before the carry trade unwind, and I think it'll resume that broadening. That probably means that the Magnificent Seven, when you get a drop in them, it's probably something worth considering buying them. But I think they may just take a pause here, and the market will resume its broadening into the S&P 400 and 93. And we could also see some broadening into the SMID caps, the small and mid cap stocks.
And how volatile do you think the market's action is likely going to be, just judging off of what we saw yesterday when we look ahead to the CPI print that's coming in, and looking even further ahead to that next jobs print, all coming before the next Fed meeting? Is this something, maybe not to the degree as to what we saw yesterday, given a lot of that was from the bounce back from Monday, but is that something that's going to become this new norm?
It may very well. I mean, it was only a week or two ago where people were observing that the VIX was extremely low, that there wasn't much volatility. The market just was going up day after day. It was a long time since we had a 1% or 2% sell-off, and well, here it is. So these things do kind of cycle, and we could, like I said, I think between now and the elections, I see churning. So churning is volatility.
Ed, great to speak with you again. Thanks for bookending our coverage here over the course of this week. We really appreciate it. Ed Yardeni, who's the Yardeni Research President. We've got all your markets action straight ahead. Stay tuned. You're watching The Morning Brief.
Treasury yields moving slightly lower today. The 10-year yield hovering just below that 4% mark, and that comes after yesterday's jobless claims helped to ease fears surrounding the state of the U.S. economy. Investors are now going to be looking ahead to the next data released, CPI, on deck next week. For more on where we are headed, we want to bring in Ed Al-Husseini. He is a global rate strategist at Columbia Threadneedle. It's great to see you. So certainly it's been a wild week for the market. It's been a wild week for the bond market, especially when you take a look at the 10-year yield and the massive jump that we saw earlier this week. So here we are sitting just slightly shy of that 4% level. Where do you think we're headed from here?
Yeah, in my mind, most likely a little bit lower. The market on the bond side still prices in an economy that's relatively healthy, as your previous guest alluded to. It's pricing in corporate fundamentals that are pretty healthy. And in my mind, the risk at the moment is starting to tilt to the downside quite dramatically in the labor market, and that's not fully priced in yet.
Okay, why is that, and what do you think? At what point would we be able to evaluate that it is fully priced in?
Yeah, it's always tough because it's an interplay between the deterioration in the labor market data, which has picked up a little bit of steam this year. The fact that monetary policy is starting to act on the economy, is starting to become a bigger drag on the economy over time. And then ultimately what the Fed does. So the faster the Fed front loads an easing cycle, the more pressure will come off of rates on the long end. The more they prolong moving slowly, the more likely it is that longer end rates will come down a little bit faster.
What do you think the probability is of a recession at this point?
Yeah, it's such an intriguing and such a difficult question. Let me frame it this way: if the Fed doesn't act, if the current sort of status quo persists, with the Fed cutting, perhaps 25 basis points every other quarter, that probability, in my mind, probably becomes a third, maybe 50% over the next 12 months or so. The faster the Fed acts, the faster they're able to take some pressure off of the economy via rates, the lower the probability will be next year.
Ed, we just heard from your Denny last block, and he was telling us that he actually doesn't think the Fed needs to act in September. Do you disagree with that?
Yeah, I would say he's correct in the sense that the economy at the moment looks pretty good. Growth is tracking around 2.5%. Corporate fundamentals are pretty decent. There aren't a lot of signs of a misallocation or leverage in the system that's under stress. I think where Al disagrees the direction of travel. The fact that monetary policy is pretty blunt, it acts with long lags. The fact that the labor market is slowing right now, it means that train is in motion. And what the Fed has done over the course of the past couple of years is catching up with the economy. And that's the risk going into 2025.
What is the most critical piece of data that we should be keeping tabs on then within the broader kind of scheme of what the Fed is going to be tracking, especially as you're talking about the labor market right now? Is it wages, or is it how those wages are being put to use on the other side of that?
No, ultimately, I think you're absolutely right. Wages is a core metric. It's the transmission mechanism from the labor market into inflation. It has been coming down. It's one of the things that's given the Fed confidence to even start talking about a rate cutting cycle. The fact that wages are decelerating at a pretty decent click right now, to me, raises a yellow flag. Obviously, the unemployment rate is creeping up in the background. That's another one. From a market's perspective, the thing that I think the Fed is sensitive to and that we're watching very closely is credit spreads. In the course of the last week, credit spreads were very well behaved. They did widen a little bit, but no signs of panic, nothing commensurate with the movement in the VIX index, for example. If those credit spreads start to widen more materially into the end of the year, that would again raise a yellow flag for the Fed. That's a tightening of financial conditions and a sign that the economy is starting to slow a little bit more.
So Ed, we've asked a number of strategists, bond market, equity market here over the last couple of days, that what investors should be doing now. And I think that at least from consensus, it almost seems like investors shouldn't be doing much. They shouldn't be panicking. They shouldn't be really having a massive adjustment to their portfolios. Do you agree, or how are you adjusting at this time?
Let me highlight two strategies that are top of mind for me. One, if you're heavily invested in cash, that proposition is becoming less attractive. The Fed easing cycle is coming into view. There's going to be a debate in terms of how front-loaded it is, how rapid it needs to be over the course of the next 12 months, and so on. But if you're invested in cash, the opportunity cost of staying there is rising, and it makes sense to diversify that into duration. The second thing is credit. In terms of credit fundamentals, again, corporate fundamentals are still quite good heading into the end of the year, into next year. You're able to lock in relatively high quality income at around 6-7% for the next several years. That's a very attractive proposition relative to the valuation in equities and cash as well.
Ed, just lastly, while we have you here, and shifting gears slightly, but kind of in the same vein here, since we're talking about the Fed, you got former President Trump saying that the president, that he would actually like some say in the Fed policy decisions. I mean, what do you even make of it when you hear a former president and current candidate for election saying that?
I mean, the bottom line is it's not great. Investors who buy U.S. Treasuries ultimately are underwriting the institutional quality of the Treasury market, and that includes the Fed and its ability to target inflation independent of what's going on in the White House. So when you see either Congress or potential occupants of the White House start to imply that they will have a bigger say in what the Fed does, it's never good. Of course, let me take a step back. There's a lot of conversations in terms of what the next administration could potentially do, both Republican and Democratic. Things tend to mellow out once people are in office. So I think at this stage, it's not a reason to panic, but it's not great. Let me put it that way.
Ed Al-Husseini, who is the global rates strategist over at Columbia Threadneedle. Ed, thanks so much for taking the time here on this day.
Thank you.
Appreciate it. All your markets action straight ahead. Stay tuned. You're watching the Morning Brief, everyone.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
You're watching The Morning Brief, and we're watching what's trending on Yahoo Finance. Those stocks are ELF, ticker symbol CGC, and NKLA. All right, ELF, Canopy Growth, and Nikola. Let's get into it here. ELF shares dropping. Eyes, lips, and face is what it stands for, folks. Despite beating sales and earnings expectations, it's a sad face for the shares right now. The cosmetic company issuing a cautious full-year forecast, citing transportation costs as a headwind to its outlook. There you're taking a look at shares here today, down by 14% as of right now, and especially in a time where if there is anything that it seems like consumers are still able to lean into, it's some of the little luxuries, some of the self-care, and some of the beautification. I mean, I use more of these products now.
You got to. You're on TV.
I do have to.
Some powder.
Thanks for the reminder.
Goes a long way. Maybe some more things down the line. All right, let's take a look at Canopy Growth because shares are sliding this morning. You've got cannabis company posting a wider loss and also its revenue dropping in the latest quarter. You're looking at losses of just about 8%. When you go beyond that, maybe a bit of good news here. Cost of goods sold, that actually was lowered by 31%. Cutting and selling and general administrative costs, those were lowered by 24%. CEO David Klein, despite some of these troubles, remaining optimistic, saying that it sets the stage for growth in the second half of fiscal 2025. And remember that this comes on the heels of the comments from Trump yesterday, saying that he might actually be shifting his position in favor of looser cannabis laws. That's why we saw a bump across the sector yesterday.
All right, a little bit more green. All right, Nikola shares rallying. The battery electric truck maker topping the street's revenue expectations. There you're taking a look at a little more green. It's up by about 15%. But let's remember what the long-term trajectory has looked like for the company's stock here. Overall, we're taking a look at the year-to-date, still down by about 65% over the course of 2024. Over the past year, down by about 84% here. Just looking further into what the company had announced here and put one stat on this. It's interesting. They reported the strongest top line in the history of the company. Revenue, $31.3 million. That's up 318%. But when it's a low base, it's easier to see a big rise.
Yeah, certainly when the stock's up nearly 70% this year. The estimates, or I guess the bar has been set rather low. All right, coming up, chips are leading stocks higher today. Strategists torn on whether it's time to buy the dip or if we could see another pullback. We are going to discuss when we come back on Catalysts.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs.
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance. Just after 10 a.m. here in New York City, I'm Shauna Smith alongside Madison Mills. And let's dive into the catalyst moving markets today.
Stocks are ticking lower after a week of turmoil. Just taking a look because stocks are now reversing earlier gains. It's appearing like we're seeing a lot of pressure, particularly in the big tech stocks. It is coming on the heels of that print from TSMC. We're seeing that stock now flipping into the red, and we're seeing a similar pattern from a lot of the broader tech names, including tech giant Nvidia. We're also now seeing movement in treasuries, with the 10-year hovering under that 4% mark. Is the rotation away from tech going to continue as we head to the close? We'll discuss all of that throughout our show.
And the broader market sell-off triggering wild swings in the big tech trade this week. Could next week's inflation report be the next big catalyst for the group? We're going to talk to Luke Bars. He's from Goldman Sachs Asset Management about that in just a few moments.
And big reactions from global markets on the back of last week's manufacturing and jobs data. Next week, the inflation and retail sales reports out will be the next big test for markets. We'll discuss what that could look like moving forward. But first, let's take a look at where stocks stand right now. You're looking at downside pressure in the S&P and the NASDAQ. Again, as I mentioned, reversing some of the earlier gains that we saw with red across the board. The S&P and NASDAQ are moving to the downside, as I just mentioned. It's been a roller coaster ride for equities throughout the week, with the S&P notching its worst day since 2022 on Monday, and then its best day in about the same time period just a few days later on Thursday. So where do we go from here? Joining us now for an outlook on the market, we've got Mona Mahajan. She is a senior investment strategist at Edward Jones. Mona, it's great to speak with you. I know that the choppiness here is not over, and that's evident given the flip that we've seen the market do just 30 minutes after the open this morning. What is today telling you, and what do you think the narrative will be as we head to the close today?
Yeah, it's a great call out. And look, markets have certainly calmed much more meaningfully over the last couple of days than we saw Monday and Tuesday of this week even. And keep in mind, look, we've seen this week alone, the jobless claim figures that came in below expectations provided a little comfort to the market that is really looking for direction on a couple things. One, is the U.S. labor market headed towards some sort of meaningful collapse or downside? And two, is the broader economy headed towards a downturn as well? And I think for us, both of the answers to both those questions are no. And what we're seeing in the labor market, and we'll get the next jobs report on September 6th, is yes, it's cooling 4.3%. 4.3% unemployment is higher than we've seen any time this year, but much below the long-term average of about 5 to 6 unemployment rate in the U.S. And keep in mind, this higher unemployment has come because new entrants are entering the workforce, not because we're seeing job losses and layoffs. And so to us, it's a much more benign environment. We don't see a recession on the horizon. And in that backdrop, if the Fed is cutting rates and there's no recession, that tends to be pretty good for financial markets over time.
So then, Mona, what's going to be the catalyst then? Because it seems like investors did overreact a bit. Maybe there's not too much to be worried about. But in terms of reassuring those skeptical investors, because we were talking to so many strategists over the last several days, and they've been saying, hey, it's smart to stay on the sidelines right now. So what is that maybe one or two data points or one or two readings that investors should be looking for in order to gain that confidence?
Yeah, look, we have talked about the next jobs report on September 6th. We would really like to see that unemployment rate stabilize. We'd like to hear more about what's driving the higher unemployment. And then, of course, we're looking at GDP growth and earnings growth as well. So GDP growth, if you look at something like an Atlanta GDP Now, which forecasts third quarter, they are calling for 2.9% GDP growth, well above, of course, positive territory and well above even what we call trend growth rates of 1.5% to 2%. And then more broadly, earnings. We know earnings underpin the stock market. And right now we're seeing 10 to 11% earnings growth for this quarter and notably still for the full year. So this is a market where we will continue most likely, to your point, to see choppiness. We're heading towards a more volatile September and October period, traditionally more volatile in the markets. And of course, then we're headed right towards election day. So could we put in a bottoming process during that time? Absolutely. But what investors really want to be mindful of is that is your opportunity. If you haven't yet looked at your portfolio, make sure you're diversified. If you haven't rebalanced, and really if you haven't bought quality investments in a long time because you've been waiting for the opportunity, this is a great time to think about that as well.
Mona, I'm torn on my next question for you because you just mentioned that we're in this kind of seasonally difficult moment, but also you got to look for quality. And I don't know whether I should be viewing this moment as a head fake where we're stressing out and it's not that big of a deal because this happens every fall, or if it's something more sinister that does require a rethinking of people's portfolios. Yeah,
it's a good question and probably something a lot of investors are debating even today. When we think about a bear market, a 20% plus decline in the stock market, those usually happen for a few reasons. One, we're in a recession or entering a recession. Two, the Fed tends to be raising rates when we're in a bear market. Or three, there's this unknown factor, whether it's a geopolitical risk or something like a pandemic. Much harder to handicap that third one. But the first two is really environments we don't see as our base case as of now. As we talked about, we don't see a recession, and the Fed is actually going in the opposite direction. We think, in fact, they'll start signaling rate cuts perhaps as early as the Jackson Hole meeting on August 22nd. And so that's why we think this volatility, we know corrections are the norm. 10% to 15% correction can happen in any given year, but we don't see that turning into something more nefarious, to your point.
And Mona, real quick, when you take a look at tech specifically, we're going to talk a little bit more about this later in the show, but when you see the type of reversals or wild swings specifically within the leadership that we had seen for so long within the market, what does that tell you just about how much jitters there are in the market, how much investors are on edge? Is there something more broadly maybe that we should be taking from those wild swings?
Yeah, look, we know mega cap technology has moved perhaps too far, too fast in the first half of the year. The NASDAQ was up almost 25% through mid-July, and that Magnificent Seven was up closer to 40%. Valuations were probably extended, and were they due for a bit of a pullback or at least a correction or period of profit taking? Probably yes. But when we think about the theme for portfolios, the theme for the last 18 months or so had been narrow portfolios are winning. You had to be focused on tech, more concentrated and overweight there. When we think about the next 12 to 18 months, we think the theme and the winning portfolios will actually shift to you need to be diversified. That doesn't mean wholesale give up on your technology, but you need to make sure that you have value in cyclical parts of the market, perhaps some mid-cap stocks in there as well, a little bit of international exposure, and that we think will be a more winning portfolio. So that's really where you want to make sure as we're headed in, especially towards a rate cut by the Fed, that you're looking for a diversified portfolio in your own investments.
All right, Mona Mahajan, always great to get your insight. Thanks so much for joining us here this
Thanks so much, guys.
Senior Investment Strategist at Edward Jones. All right, turning now to more about the tech sector, because you've got Nvidia and Taiwan Semiconductors reversing some of those earlier gains. At least Nvidia now just below the flat line. You still got Taiwan Semiconductor holding on to those earlier trades. And as you take a step back and try to figure out where Wall Street stands right now overall on the tech sector, and especially the wild swings that we see played out in the market, it seems to be that Wall Street is split on where the sector is headed from here. So here with who has been tracking every moves and what analysts are saying, strategists are saying, we have our very own Josh Schaefer. And Josh, you're looking at two notes, right? And they kind of contradict themselves a little bit.
They do, and I don't know. I just think chips have been the most interesting part of the market probably this week. The swings have been insane. You're looking at Nvidia down 8% one day, up 8% another day, basically opposite every day, and sort of the overall chip sector doing that. And two notes caught my eye this morning out from strategists. So Michael Hartnett over at Bank of America saying that he still thinks that leadership of AI is going to continue to wane over the next couple months into the second half of the year until EPS gains more visibility. So him essentially saying, yes, these estimates for some of these stocks in the AI trade, in the Magnificent Seven trade, have held up, these earnings estimates, but is that actually going to come to fruition? He wants a little bit more evidence before feeling confident in the AI trade. And then there's sort of the other side of this, which is simply tech just got its face ripped off over the last month, and maybe that's a trade that you just want to get into because it's been a leader of the market. So our friend Keith Lerner over at Truist had downgraded tech in June after tech had outperformed by a significant amount. He was looking at a 1 month rolling average of tech versus the S&P 500. In June, tech had absolutely ripped. So really the key takeaway here is at the end of that chart where you see greatest in 20 years, worst in 20 years, that was back-to-back months. You had massive tech outperformance, and Keith said, I want to take some chips off the table. Now you have massive tech underperformance, and he's saying, okay, maybe this is an interesting entry point.
You timed it well.
And he points out in this note, yes, of course, Keith did time it well. Keith is a friend of the show. We got to point it out when Keith times it well. But he also pointed out in that note, and I think it's important to mention, he's not saying that he's calling bottom on the tech sector and it's going to just definitely go up from here. He said that he's still expecting some chop in the overall market and maybe some chop in the tech sector. But when you have a sell-off like that in a sector that has been a secular leader of the stock market, maybe it's time to up your position a little bit.
And to your point that you mentioned earlier, it does sort of feel like right now you can't be calling it tech broadly and applying the same kind of investment thesis across the board. It feels like there's chips, there's Nvidia specifically, there's the hyperscalers, there's the other big tech and mini AI plays. It feels like you can't kind of rest on mentioning AI a certain number of times in your earnings anymore.
No, and when you look at the market over the last week, and yes, like the NASDAQ has been a big mover to both sides, right, Maddie? But you just mentioned it. When you look at the mega caps, they've been moving a little bit differently. You're seeing dramatic moves in Nvidia and perhaps less dramatic moves in some of the other names. The constant reminder we always bring up that these are different companies that actually sell different things, and so the story isn't really the same. I don't know. I think it's going to be interesting, though, over the next 2 or 3 weeks. We're still several weeks out from Nvidia earnings, and I know you guys have been asking strategists this, well, what's the catalyst? How do we know when it might be time to get back in? It seems like that just isn't a clear picture for another couple of weeks, right? Like we're sort of in this middle ground until Nvidia earnings.
Well, exactly. And I think that also has largely been the consensus, right? When you take a look over the next couple of weeks, it's hard to identify what exactly would be the catalyst, at least in the short term. But people are remaining optimistic maybe about what Nvidia's results are going to tell us about the broader chip space. So we'll see.
Imagine if they disappoint.
Oh, no.
No, then I'm going to be very
Remember
wrong.
last
I'm
earnings?
lose my bet with Josh.
Last earnings season, we talked about how Nvidia was going to drive the market and their earnings were going to matter so much. They beat, and it didn't do that much for the market.
You make a good point.
If they miss, I would say that would be a pretty negative catalyst. It would be a bad time for them to finally disappoint in these earnings.
Yeah, exactly. All right.
Plenty of time to talk about it.
There is a lot of time to talk about it. And we're going to spend even more time talking about tech. All right, Josh, thanks. Well, the massive sell-off that we saw earlier this week, allowing some of that frothiness that's driven the market gains this year to subside. So is now the time for investors to buy into tech at more attractive prices, or does it make sense to stay on the sidelines? We want to bring in Luke Bars. He is the managing director in fundamental equity at Goldman Sachs Asset Management. Luke, it's great to see. So I think so many people are trying to figure out what they should be doing, what the approach should be when it comes to tech right now. Do you think it's more attractively valued, or how should investors be buying in at these prices?
Well, I think our starting point is selectively there's great opportunity across the broad market, but specifically in tech as well. There are some transformational themes that are coming through that are driving earnings. there's no doubt there was a bit of froth in the market. And what we've seen in the last week or so is a correction that is, I think in many cases, quite healthy. But if we're finding where those fundamentals are still resilient and we're looking at how the market has traded in the last couple of days, it's really coming back to where can I find that earnings growth? Where can I find that cash flow generation and profitability? And I think for us now, there are some select opportunities that we think are quite appealing.
Luke, we were just talking about how you can't be looking at all of the tech names as a monolith. And I know that you in particular are trimming your exposure to hyperscalers. Talk to me about what long-term narrative that call is based on.
Yeah, so I think your first comment is critically important. I think we've just looked at technology and assumed everything is homogenous when actually there's huge underlying trends and themes that we need to decompose. And so for us, the Gen AI trend is a very transformational one that has been rewarding to some of the enabling technologies in the course of the last 18 to 24 months. And you've seen that crystallize into significantly higher earnings expectations and outcomes. What we're seeing now is a little bit of an adaptation in hyperscaler CapEx trajectory. And so we still see a lot of investment coming from those hyperscalers into chips and into the AI trend, but it's just being a little bit more thoughtfully delivered than it may have been over the last 12 months. And so where we're trying to be selective is if we haven't seen that pullback in valuation, if we're not seeing necessarily the normalization of that CapEx cycle that we think is healthy, we just need to be a little bit more cautious, but still selectively trying to find exposure that we think can deliver good upside on a forward 12 to 24-month basis.
Luke, when you take a look at the volatility that's played out more broadly speaking here this week, but it's been very noticeable even within the Mag 7 names, and specifically Nvidia, it seems like every other day it's either down 7% or up 7%. What does that then tell us maybe about the expected volatility that we could see as the market remains so dependent on some of those uncertain factors, and a lot of that surrounding the econ data prints and what exactly that tells us about the Fed?
Yeah, so I think there's two critical parts to this. One is just the market had to absorb some negative macroeconomic data points that changed the direction of travel, or at least the pace of travel for the Fed. And so that was a bit of a whipsaw effect. But once the market recognized that actually we're on a cycle where the Fed is going to be normalizing rates, it might be a little bit quicker in the next 3 or 4 months than maybe was expected 10 days ago. But that cycle should be favorable in terms of just maintaining growth at a relatively stable level and helping to positively influence earnings over the coming year. Now, I think what is important within that, as we look at it more broadly, is saying, okay, well, what else is important within this that the market is focusing on? And when we come to technology, what is very apparent is not just the macroeconomic picture, but also the fact that people want to see, and I think Josh mentioned this a second ago, evidence that Gen AI trade is actually driving positive outcomes. And where the market has struggled a little bit in the last month or two is show me in the software space where you have clear proof statement that this is additive. And so show me where you're putting that capital investment to work, that I can deliver a positive earnings outcome. And that is a little bit more difficult at this point because we just don't know how to utilize and apply some of those new techniques and capabilities in those software products to enhance that solution.
Luke, what do you look at to suss out the answer to that question?
Look, I think it's a very, very difficult question to answer. And I think the simple statement would just be we have to just be cautious and let it play out over the next year or two, because it's very hard to say with certainty this specific business has a solution, this specific business doesn't. But you'll get more evidence as we go through. I think our starting point is those businesses with very large market share will likely be able to maintain that market share as long as they stay up with the pack on some of those Gen AI capabilities. And so the question then is, how much are they having to spend and invest, and how attritional is that to margins and earnings? And to the extent that they can do that in a balanced fashion, actually those major software businesses still look fairly attractive.
Luke, we've talked a lot about tech. I'd be remiss to not get into your small caps call with you. You talk about you have some bullish sentiment on small caps, it seems. Does your view on small caps require a certain amount of speed from the Federal Reserve in terms of rate cuts?
Well, it's predicated on the view that the US economy is still fairly robust. Yes, we will see a little bit of a normalization in growth. We saw this 2.8% annualized growth trajectory, and that will come down a little bit. But our current activity indicators still say troughing out at 1 to 1.5%. So this is still a soft landing scenario. And so the Fed dynamic is going to be one where there's a little bit of extra flexibility the Fed has if that growth cycle comes down a little bit more significantly. But we think the underlying trajectory for small caps, which is tied into the US domestic economy, is driven very favorably by what will be a rate normalization cycle. And now whether that's 50, 75, or 100 basis points over the next 3 or 4 months, I think is going to be data driven for the Fed, but we know the trajectory we're likely on. And what I would say is for small caps specifically, you have a very clear history that from that point of peak rate, following that first rate cut, the next 12 months, you typically see 10 to 15% outperformance of small cap versus large cap, in principle, because one, you are seeing that positive impulse of monetary policy, but also because these are businesses that are tied to floating rate debt. And so that normalization of rates is very healthy in terms of margin and healthy in terms of passing through into superior earnings.
All right, Luke Bars, he is the Fundamental Equity Managing Director at Goldman Sachs Asset Management. Luke, thanks so much for taking the time to join us.
Thanks, guys.
Keep right here on Yahoo Finance. We've got much more of your market action ahead. Again, when you take a look at the major averages, we've been trading almost it seems like whiplash here at this point. Up and down here when it comes to the flat line, you've got the Dow just below the flat line, off just about 72 points. You've got the S&P and NASDAQ back in positive territory. The S&P now just above the flat line. We've got much more when we come back.
A look at some trending tickers on this Friday morning. You're looking at shares of Rocket Lab right now up over 11%, rising after they completed a successful engine test, what they call a hot fire of its new rocket engine. That is, I guess, code for a test of the engine here. Now, this comes also as their results for this quarter were looking good, led by strong demand for its launch services and space systems products as well. Just running through some of the analyst commentary, I'll start with Citi here, saying production and launch infrastructure for the program continues to fall into place, and there appears to be plenty of pipeline for the rocket. Also, again, noting that hot fire test of the engine being successful and indicative of successful launches moving forward here. Also, interestingly, just looking at the numbers, revenue was up 71% year over year, and adjusted gross margins came in just below expectations. But looking at that top line revenue number, it looks like a good quarter for them.
It looks like they might expect to see a bit of an improvement on that adjusted gross margin. But going back to the hot fire test, because right before we were coming to air, we were supposed to be talking about this, and I was asking what the heck a hot fire test was. In case you don't know, it's to evaluate an engine's performance and also obtain information that can help it achieve certifications and type approval. So obviously that's very critical to this industry, and why this is having such a massive impact on the stock here, just in terms of what ultimately this means. And it also just ties back to the city comments, Maddie, that you were just suggesting, or you were just saying there, which suggests that there's plenty of pipeline here for the rocket. So again, this is a bullish sign here for Rocket Lab within this race, trying to best position their company amidst all of this. But again, shares moving to the upside just about 11%. And like you mentioned, the numbers actually for the second quarter, they were impressive, especially on a year-over-year basis. Their adjusted EBITDA loss also just around 21 million. All right, well, shares of Sweetgreen on the move today. They're rallying this morning after the company increased its revenue and same-store sales outlook for the year. Same-store sales increasing 9% from just a year ago. Yahoo Finance's Brooke DePalma joining us now. And Brooke, you're looking at shares up just about 28%.
Yeah, lots of excitement and momentum on the street as this fast casual sector continues to outperform what we're seeing as a very challenging restaurant landscape. And investors really focusing on that same store sales growth of 9% in Q2. That was the best in 2 years. And now that gives the company confidence to raise its same store sales outlook for 2024. Now is expected between the range of 5 to 7%. That's up from 4 to 6%. And there's lots of excitement around this future restaurant design. Sweetgreen calling it the Infinite Kitchen. And what we're seeing there is 7 new Infinite Kitchens will open in Q3 or Q4 of this year, in addition to retrofitting 2 to 3 restaurants. And that's a part of a total expectation to open 24 to 26 net new restaurants in 2024 by year end. And now, based upon this Infinite Kitchen, they're seeing strong performance and an increased speed of service. During this quarter, they did open one here in New York in Penn Plaza. That's a hub for transportation here in New York. And they say that this Infinite Kitchen has the potential to reach 500 bowl orders per an hour. And the average order completion time is just under 3.5 minutes. So this really increases the speed of service. Menu innovation, also a huge plus for Sweetgreen here. They introduced that caramelized garlic steak. And what they're seeing here is that it's bringing in new guests, increased traffic, higher check sizes. JP Morgan analyst says that this reaffirms the standing as the company steadily rebuilds credibility after a tough post-COVID and post-IPO environment. They are still lower than that IPO price that they debuted at of $52 a share. And so lots of momentum here. Sweetgreen really putting into action to really turn things around here.
All right, Brooke, thank you so much for joining us on that. And we should also mention, stay tuned for Brooke's interview with Sweetgreen's CEO coming up at 4 p.m. Eastern today. You will not want to miss it. Another trending story that we are watching here in the healthcare space, GLP-1s, a key driver of the broader healthcare space this earnings season. Companies like Eli Lilly and Novo Nordisk showing that demand for weight loss treatments does remain strong. Yahoo Finance's senior healthcare reporter Anjali Kamlani joins us to break it down. And Anjali, I think for me what's been interesting about this is that it's not all GLP-1 providers created equal this cycle. It feels like there have been some key winners and losers.
Yeah, this is the first time that you've seen sort of a little bit of a difference between Novo Nordisk and Eli Lilly, the two market leaders. Novo, while it did beat on its earnings, it did miss some of the sales estimates, as well as downgraded or trimmed a little bit, if you will, its operating margin for the year. But it did increase sales, as well as Eli Lilly followed suit in that respect, but they increased on both sides. So we're looking at what that means for the future of the market and how that really shapes the race ahead. Lilly coming out a little bit stronger in a number of ways. First, of course, with the increased sales, Zepbound, its weight loss GLP-1, really climbing, already reaching blockbuster status after just 2 quarters on the market. It also, Lilly is also moving ahead with its application, or at least slated to move ahead, and indicated it's on track for submitting Zepbound for a heart failure, to help treat a heart failure. Novo Nordisk, on the flip side, having to delay their filing, even though they were slated to be first to file. So that's just sort of the shift you're seeing. It seems like Eli Lilly also getting their drugs off the FDA shortage list, just being really a big boost. So we had one day where Novo came out and the market was kind of like, oh God, what's going on? And then the very next day, everything was settled, doubts are gone. But I also want to take a look at sort of like a 6-month check-in, if you will, of the rest of the candidates that are coming down the pike. At the start of the year, we had companies like Pfizer, Amgen, and Roche really looking like they were going to take a good stance in the market. Pfizer, however, has been slowing down, its prospects decreasing as it ran into some trouble with its drug, the oral GLP-1 that it is now in clinical trials with. It's still figuring out the dosing for its once daily. It had a twice daily that didn't have good tolerability. So they're moving a little bit back in their pacing. Meanwhile, Amgen moving ahead with its once monthly, potentially injectable. That's in phase 2 and going to be going to phase 3 trials soon. That's something that could be a good market contender. And then you've got Roche, which entered the market with a $3 billion deal, acquiring a smaller biotech that had a couple of candidates, looking pretty good there. So they're still in the game as of right now. And then there's Viking, the little biotech that came out of nowhere with a really strong results, still having to enter phase 3 trials. And that's one of the ones that a lot of folks are still focused on, whether or not it can make it to the finish line on its own or ends up being an acquisition target. If you look at its stock, it's up 200% year to date. So that's really quite a move, and that's because of the great results we saw at the start of the year. So that's sort of how the market's shaking out right now. If you look at sort of where the competition is, I had a chance to catch up with Jared Holes, Mizuho's healthcare sector expert, and he talked about sort of that hiccup we saw in the middle of the week between Novo and Lilly, saying that Lilly's results are a reminder that it's silly to look at either of these names on a 90-day basis, which is what we do in the market, especially because this market is north of 100 billion. So we're going to need more of those contenders to come in to really see how it plays out.
All right, Anjali, thanks so much for bringing us that reporting and for all of your coverage on the healthcare space throughout the earnings cycle. We do appreciate it. We're going to have all of your markets action ahead. I was just taking a look at what we're seeing in the Treasury space. We are seeing the 10-year in particular under pressure this morning. A little bit of a bid up in bonds could be why we are seeing the market flipping around so much. If we take a look at the S&P and the NASDAQ right now, you are seeing some mixed performance across the major averages here. But as you can see, they're seeing that 10-year under a little bit of pressure, and looking at the S&P and the NASDAQ hovering just around the flat line there. Stay tuned for more. dollar yen is on track for its first week of gains since June. The unwind of the carry trade that drove part of the market sell-off we've seen has slowed throughout the week. That slowing coming on the heels of better than expected economic data and dovish commentary from the Bank of Japan. So the big question, will the slowdown of the unwind continue here? Joining us to discuss, we've got Mark McCormick. He's TD Securities Global Head of FX and EM Strategy. Mark, great to have you as always. So you talk about this in your note. You say that the BOJ pivot has likely ushered in a regime change for the yen. Given that, do you think the unwind of the carry trade is over for now?
I do not think the carry trade unwind is over. I think we have a long way to go. I think you need to think about whether it's kind of tactical and the structural nature of it. The structural nature of the carry trade is that for pretty much around the last decade, Japanese investors have put their money, mostly pension funds, which accounts for about 80% of GDP, in other markets. So the assets that they're tracking in other markets are actually a big form of the carry trade. It's hard to say this is yen specifically. You know, they're betting on higher yields in other places. But a piece of this carry trade, if you look at the correlation of the NASDAQ to the yen, is the outperformance of U.S. equities and probably investments we have in Japanese pension funds into those U.S. equities, which have been very strong performers over the last 5 to 10 years. So I think a big piece of the yen carry trade is it links together a lot of these different global themes, which is it was very, very easy to fund in yen. And it was very easy to find other places around the world that offered higher yield or higher growth. And now the entire complex around that system is now starting to unwind.
So then, Mark, what kind of adjustments have you made, or are you advising investors to make if the pain isn't over yet?
We've been talking about this for months. Like, we have pushed back. I think we had the same conversation probably in April or May around the Goldilocks trade. To me, this was, you never know the catalyst, but the conditions for volatility to rise, I feel like, is not very surprising. I feel like what we're trying to do is piece together what caused this, like U.S. data slumping. I would highlight as well that if you look at Chinese data, it's slumping faster than U.S. data, and Eurozone data is also declining. If you look at the uncertainty around the U.S. election or geopolitical uncertainty, we had macro volatility basically setting back to levels that we were in 2021 after the world reopened from the pandemic. So the levels that we saw in global macro vol versus all the conditions that can change them, it's always hard to get the precise trigger right of what causes this thing to unwind. But for me, it was very clear that the thing that was going to happen is we were going to have a series of events the markets weren't expecting. Namely, we were looking for the BOJ to hike in July. This, to me, was a function of, again, that the currencies that are undervalued, that are short plays in the carry basket, are also the currencies that the U.S. administration has called out on being undervalued, whether it be the Korean won, whether it be the Japanese yuan, whether it be essentially the Japanese yen. These are all currencies that are fundamentally undervalued. So I still think that the drivers in place is something that we have a long ways to go for the carry to unwind. And we're probably in a new regime where, again, the Goldilocks trade is essentially fallen by the wayside.
Is the Chinese yen the next carry trade unwind that investors should look out for?
So that's a great question, because I think you need to kind of disentangle the correlation of the yuan versus the yuan. They have recorrelated right now. They're being driven by similar factors. So the Chinese yuan is a good funding for a carry trade. And again, if you just think about what drives a carry trade in markets, why people love it, it's very simple. It's what you need is rate divergence. So one country needs higher rates, another country needs lower rates, and you need low volatility. So you assume the conditions are not going to change. That's also what makes it very vulnerable to very violent drawdowns, which is what we've seen. So what I'd say is the coupling of the correlation between the Chinese yuan and the Japanese yen makes sense because they are both funding currencies. Mechanically, as we move out of what you would call, say, the period of the next couple of weeks and into months and quarters, I think they're going to probably recouple again, because I think they're two undervalued currencies, and I think they need to both be stronger. But I think in the short term, the BOJ is moving in a direction that's going to continue to tighten policy. The yen is way more undervalued than the Chinese yuan. And I think a big driver here is that Japanese flows, or pension funds particularly, have been pushing money outside of Japan. They will be bringing money home. They will be resetting their asset allocation targets to buy more JGBs and buy more local equities. And I don't think you have the same capital market mix in China. So that's where I do think we'll see divergence in the next couple of months, as the yen should outperform the yuan. But I think if we measure this in terms of like over the next year, over the next 2 years, they should both be currencies that strengthen relative to the dollar.
So, Mark, that was the comparison of currencies I wanted to ask you about, but now I want to do a comparison of tech to currencies. If you're a tech investor, I feel like this week really had you looking at the dollar yen, and I'm curious if the reverse is going to be true. If we get bad Nvidia earnings, for example, does the yen appreciate off of that?
It's hard to disentangle cause and effect in all this because there's so many pieces. I think one thing that you could take away from the kind of the undermining of the yen carry trade and where we see the yen strengthening, where we see, again, the BOJ hiking, and we're calling it Japan Inc. The government, the pension funds, and the central bank now seem to want a stronger currency. The one consequence of this is if you think about where a lot of money has gone from Japan, you could track that money as well, is it's gone into European bonds. They have picked up yield in France, they've picked up yield in other European markets. So a consequence of these flows kind of repatriating coming home is, one, real rates go up. So curve steepen, real rates go up. This is challenging for tech, largely because tech is like premised particularly on easy money and easy monetary conditions and low interest rates. So I would say, it could be either or. Like if Nvidia is weak and that continues to see a further drawdown of risk sentiment, that would strengthen the yen. But also, again, the yen basically rallying because there's a repatriation of capital coming home, and that's causing basically a trigger of interest rates to move higher, particularly real rates. That could also be a catalyst that kind of provides the same outcome and sees earnings start to decline as well.
Yeah, Mark, to that point, if the catalyst of all this, it seems to be this growth shock, right? What does that then tell us about the wild swings or the volatility that we could then continue to see play out, given not only uncertainty here in the U.S., but also just on a global scale as well?
It's a great question because I think investors have been just focused on the U.S. and its U.S. is slowing. If you look at Fed pricing for 2024 and 2025, the Fed is supposed to be the most dovish central bank in the world next year. That makes very little sense to me. Again, because if you look at like the impulsive data that we track, that we run through our models, that we trade in currencies as portfolios, if you look at data surprises, data trends, and you kind of look at the change in consensus growth expectations, China's in a worse place than the U.S. right now. So you can't have the U.S. slowing down, China slowing down, and Europe essentially not growing that much, but coming from very low levels. The European momentum has already deteriorated as well. If you look at just global manufacturing PMIs, essentially the global economy is now deteriorating. So I'd say, again, a big piece of this is that you can't have this risk-on sentiment and low volatility with the uncertainty around the elections, the uncertainty around geopolitics, and again, have an environment where we're moving away from carry trades. That's just one that is not conducive to very low macro volatility in a weak dollar. So I think the global growth picture has to be taken in the context that if the U.S. is slowing, other countries have to offset it to allow risk sentiment to be stable. So I would say, again, what we're seeing is a marked slowdown in global growth expectations, which is not great for overall sentiment.
Mark, the control room's going to kill me, but I've got 30 seconds. I got to ask you about a technical issue that we're potentially approaching. If we see the dollar yen hitting around 146, is that a key level that we could see furthering the unwind and therefore leading to what might be another big sell-off of stocks as we head into Monday?
I'd put it this way. I think the fast money, the positioning indicators that we track that could be kind of more hedge funds that are kind of taking very tactical views on this, I'd say a lot of that carry trade is unwound. Again, the point that matters to me is if you just measure the carry trade through the balance of payments, you probably have $1.5 trillion just on the Japanese side of assets that are in foreign markets. So I would say, in a very short-term period, I don't think the levels matter too much because, again, I do think that the positioning market has adjusted a lot where our models are now long the yen. That's probably squeezed out, very short-term sentiment, like fast money chasers. But I would say, arguably, again, this is just the start of a move where if you just put it in this context, the valuation of our longer-term dollar-yen model tells us we should be about 120. So in the context of 146 or we started at 160, there is a long way to go to price out the valuations in the end. So I think, I don't think it's going to have a very big impact in the short term because I think a lot of those positions have been cleaned out. But over the medium term, I think the dollar yen is moving sharply lower, which should have significant implications outside of just the currency market.
Mark, everyone who wants to understand what will happen next with the carry trade needs to go back and watch that segment over the weekend. Thank you so much for joining us and giving us that clarity as always. That was Mark McCormick. He's TD Securities Global Head of FX and EM Strategy. Coming up, we'll continue to have all your markets action ahead, so stay tuned. You're watching Catalysts. Key week to look at the flows of markets as we saw both the best and worst day in the S&P 500 since 2022. Here to walk us through some of the biggest winners and losers of the week, we've got our very own Jared Blickery. Hey, Jared.
Thank you, Maddie. To talk about flows this week, we got to talk about the yen again. And by the way, that was just a great interview on the yen carry trade. And this is actually what we're looking at. This is a chart that goes back to the beginning of the century, shows when the yen Kate is breaking up or blowing up. And that's when we get one of these big spikes to the downside. We just got one, wasn't as big as the March 20 pandemic spike or 08 or 07 in the global financial crisis. But here's why that matters. Japan is sitting on ultra low interest rates. It actually raised interest rates last week, and that's kind of the source of this problem. But they're still very low relative to the United States and Europe. So here we have the US 525 to 550 basis points, and then we have Japan all the way down here at 0.25% or 25 basis points. So people have been borrowing in the lower yield or lower costing currency and investing in the higher yielding currencies. That is now reversing thanks to the Bank of Japan's decision last week. And let me just show you and share some of the insights by Michael Hartnett's team over at Bank of America talking about the zeitgeist today. Here's what the BOJ said on July 31st. The bank will continue to raise a policy interest rate going forward. A week later, they say the bank will not raise its policy rates when markets are unstable. Painfully, this is a conclusion, Wall Street has now stopped the BOJ hiking. Wall Street's October or August, September goal now appears to be bossing the Fed into big rate cuts. And that's when we get into the bond vigilantes. So here's the effect that we had on flows this week. High yield bonds, largest outflow since 23. So investors shunning risk, credit risk there. Bank loans, also big outflows. TIPS, largest inflows since April 22. I think that's an inflation play. People looking to the Fed possibly lowering rates by a larger amount. Japanese stocks, guess what? They bought the dip. European stocks, investors are shunning that risk market. And then financials, the biggest outflow since November of 23. Not surprising there. And then tech. a sixth week of inflows. That means tech inflows have been continuing for 6 weeks. So not a big disruption in that trade, which is pretty impressive. I thought I'd close out here. I just wanted to go over a chart of the yen. We just had that fantastic guest explaining the yen carry trade. We were looking at 146 here as a potential level. Let me just show you the 10-day chart. That was a year to date. We get here's a trend line. We are now breaching the trend line, about to breach this 146 level. We get down by 141, that's when things start blowing up again. So we want to keep that in mind throughout the day, probably into next week. But for right now, we'll have to see if any momentum develops. Guys.
All right, Jared, thanks so much for breaking down where we're seeing some of those inflows this week. Let's take a look at retail investors, because some retail investors using the market sell-off earlier this week on Monday as a reason to buy, scooping up some of this year's most popular trades at discount prices. Here with an inside look at some of that is JJ Kinahan. He is CEO of IG Group North America. JJ, it's good to see you here. So I think a lot of people are trying to figure out just what the read is from the retail investor, where exactly they're seeing the opportunity. What are you seeing in your data?
You know, it's interesting coming off that report talking about the technology stocks. One of the things that we see when retail investors get nervous normally is that they'll go to spiders and SPX and index type ETFs or the indexes themselves. What was interesting in this down move is we didn't necessarily see that percentage of trade increase as significantly as we normally did. In fact, what we saw was many, as you just said, using this as an opportunity. And it's always interesting to me that every crisis, so to speak, we've had over the last 5 years where retail traders tend to start are two technology names, Apple and Microsoft. They have great cash flows. People trust them. They pay, decent dividends. And once again, we saw those be the first two places our clients went to when things turned tough and look for. The other stock I found very interesting, an older school name, but a stock that's performed very well, Coca-Cola. So those three were sort of the names that led. Apple and Microsoft are going to be names that retail trades significantly anyways, but made up a larger percentage of trading on Monday and Tuesday for sure, as people were looking for places to go buy.
What activity are you seeing in Intel specifically?
On Intel, our clients have cut back on it pretty significantly. And in fact, Intel, I would say right now, normally you have a little bit of a buy bias for retail traders. They're normally buyers of about 52%, sellers of 48%. It's actually a pretty even flow. But what we're seeing in Intel is a little bit of the opposite. The selling activity is outweighing the buying activity. You're actually seeing about 55% sales, 45% buys. A little bit unusual, but for retail activity, that's actually pretty bearish, to be honest with you.
JJ, what are you seeing outside the tech trade? And I want to bring up REITs and some of the opportunity within commercial real estate, because Maddie and I were discussing yesterday, we have been getting questions just about the opportunity there, especially the fact that they pay a dividend. Are you seeing a bit more interest there?
Well, it's interesting for longer term holdings. Yeah, you see a little bit. I'll start with, I'll break it up into two areas. Number one, if you look at people who play it, they often play it through the ETF IYR, which has actually done very well. And, having a day today where it's off a little bit, but done well throughout this bit of crisis. But the two names where retail really goes to in the REIT space are SPG, Simon Property Group, and IRM, Iron Mountain. Those two stocks, if you look at the chart over the last month, it is straight up to the right. And the reason being, all the talk of interest rates coming off help their businesses significantly. And so people who have been investing, our retail clients who have been buying, have done fairly well on that. The other thing, they both tend to pay very steady dividends. And we just saw Simon Property Group for the third year in a row increase their dividends, now yielding above 5%. So that's why people also like it for a little longer term play. I think the real key in that space is going to be, with interest rates, what happens to the cost of labor and equipment. We see that to refinance, et cetera, looks like it's going to be cheaper, and that's needed for a lot of the malls and the larger commercial real estate. But is it going to be affordable for these firms now to rehab these spaces, because that's where the next competition is going to be. You know, as you guys see every day where your office is at, you know, a lot of these older buildings trying to refurbish, make it much more appealing for people to get back to the office. And I think you're going to see a lot more of that continue in the mall space also. So can they afford to do that? But I think the really big thing is if you look where loans are due, there are a lot of loans due at the end of this calendar year. So if the rate cuts, if they do start to come in September, couldn't come at a better time for a lot of the refinancing action that's going to have to take place also.
All right, JJ Kinahan, IG Group North America's CEO. Thanks so much for joining us.
Thanks, ladies.
Have a good weekend.
You too. Thank you.
Keep right here. We got much more of your market action ahead. We'll be right back.
Apple reportedly releasing a Mac Mini later this year. It would be its smallest computer ever, according to Bloomberg News, about the size of an Apple TV set. Here with the latest and what it could mean for the tech giant, we've got our very own Dan Howley. Dan, explain this to me, because when I saw the news of a Mac Mini, I thought, oh, good for my back. And then they said it was the size of the Apple TV set, which is like a little over 3.5 inches. That feels extremely mini.
Yeah, that's right, Maddie. This is going to be a desktop. It's one of the computers that they usually sell. College students use them a lot. People use them for home computers when they're just trying to, look to save a little bit of space. And so, according to Bloomberg's Mark Gurman, they are rolling out a slightly smaller one than they currently have. The current one's kind of, flat. But a little bit wide. This one's going to be more compact, apparently, and it's going to run with the M4 chip that Apple had rolled out with the iPad Pro earlier this year. I got to use that iPad Pro. I thought the chip was great. I was doing pretty much everything I wanted on it, except it was running iPad OS instead of Mac OS, which if you're trying to multitask and work, Mac OS is preferable. But this is going to be reportedly a smaller version. There'll also be a version coming later with an M4 Pro chip for people who want a little more oomph out of the system. And then there's going to be some other Macs as well coming. And so according to this report, basically Apple is going to just cover its lineup with M4 style chips And it would be the first time they really did that, because right now, there's the M2, the M3. You go into one computer or Mac on the site, and it's going to have an M2. You go into another computer on the site, and it's going to have an M3. So this would be the first time where you can just say, okay, I'm going to get the latest processor across the board for every device. And so we'll have to wait a little bit longer for those to come out. Those other devices, the MacBook Air, the MacBook Pro, the Mac Pro, for those to get the M4. But it seems as though the Mac Mini is going to be the first one out of the gate. And Apple's been doing great with their own silicon. They've pushed Intel and AMD to really step up. Qualcomm has a chip that can almost rival what Apple does now with performance and battery life. So they've obviously, got onto something that's really great.
All right, Dan, we're going to have to leave it there. Thank you so much for joining us, our very own Dan Howley. And I know that we've pushed the time of our show a lot today, but it was important for us to have a couple seconds here to say thank you to our line producer and producer extraordinaire who filled in as our EP several times, especially throughout this week. Mackenzie is her last day with us. Mackenzie, we thank you so much. It's been amazing to work with you, and I know we both appreciate it.
Yes, we will miss Mackenzie so much. She's also going off to get married in the fall, so lots of exciting things for her to look forward to. But of course, we can't thank Mackenzie enough for her dedication, for her hard work, for her leadership on this team over the last several years at Yahoo Finance, and also how quickly she climbed the production ladder too. I believe she started just around a PA not too long ago. So again, Mackenzie, we will miss you so much, and we wish you all the best.
Well, coming up, as we gave you about 40 seconds of lead time, Mackenzie, before our show comes to a crashing halt. Stick around, because you've got wealth dedicated to all your personal finance needs. Our very own Brad Smith has you right here for the next hour.
Welcome to Wealth, everyone. This is Brad Smith. I'm Brad Smith. This is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks you need to grow your money. Hey, on today's show, we're off to a ripping start here. Markets are nearing the end of its most volatile week this year. I'm talking to one portfolio manager about how you should set yourself up for financial success amid market volatility. Plus, AI is taking over the world of finance. We'll have an expert analysis on how AI can help you manage your retirement plan. And later on, a surge in summertime spending. Consumers are still ramping up their spending despite higher prices. What this signals about the economy. We've got all that and much more during today's show. But first, as market flows have created some volatility this week, there is some risk of overreaction. Here to give us his thoughts on this week's market and how he's advising his clients, we've got Matt Powers, Powers Advisory Group managing partner here. Matt, great to have you on here with us today. So let's just make some sense, first of all, of what we've seen over the course of this week.
Yeah, it's been interesting. Thanks for having me on. Good morning. We had a record high and got to a record high in the middle of last month, and some rotation away from tech, and primarily there's a few reasons. I mean, I think we all know this, but it's certainly an overly concentrated market, and the rotation away from mega cap growth stocks. But yeah, the yen, the carry trade, and then weaker than expected jobs data all fed into kind of a crazy choppy week that we just had.
A crazy choppy week, but it didn't seem like investors were, even though there was a massive sell-off that permeated over into Monday from prior week and Thursday and Friday's trading activity, it seemed like, based on our conversations with strategists and a few CEOs of some major trading platforms, that investors might have run out of some positions but ran back in to other ones where they could find some deals as well. What were you seeing on that front?
Yeah, absolutely. It's interesting. The downturn left very few holdings, very few names untouched, but investors definitely retreated to some of the safe havens, which your traditional utilities, REITs, and defensive sectors. But the bounce back Tuesday and then clearly yesterday made this look a little bit less of a huge across the board loss and more to come, and more just a typical sell off.
So take us into Yeah. It sounded like you were about to hit this, but take us into your investment philosophy then with that activity that we had seen and the retreat into some of those safe havens.
Yeah, so we're primarily dividend growth focused. So we're looking at companies that pay a history of a growing dividend, and typically we're really looking at a strong entry point into these companies. And we've told our clients, that doesn't mean that we're excluding the tech trade and the mega cap companies, but mega cap tech side, the Mag 7. But a lot of our clients have been zeroed so heavily into those that we're trying to shift here just a little bit and refocus. And our advice really has been, don't overreact to market volatility. Especially don't completely sell off some of the affected areas, but start looking more opportunistic. Start looking at some of the unloved, unappreciated areas of the market, specifically defensive sectors, small caps, et cetera. And if you're a dividend growth investor, clearly you've had to be patient, at least over the past 18 months. But now we see is the time to overweight in those areas.
With that in mind, are there, in addition to sectors, specific outperformers that you would be tracking within those sectors?
Yeah, so I'll just give you a few sectors that we're looking at, and some that we've overweighted, but consumer staples, and they're traditional defensive, but consumer staples, healthcare, utilities, REITs, and yeah, not exciting. None of those sectors are typically exciting, but we're in this situation where there's some tailwinds that are back with regards to dividend growth, and you can shift your investment strategy a little more towards holdings that are more conservative, and you've got, again, the tailwinds of potential rate cuts here in September. So in the consumer staples area, Mondelez, everyone knows Ritz, Oreo, Chips Ahoy, Wheat Thins, Triscuit, on and on. They're number one in biscuits, number two in chocolate, number three in pastries and snack bars. But the thing that's striking with them is right now you'd lock in a once in a decade high in their dividend yield. Q2, they actually just increased their dividend payouts 11%. So, if you're a dividend investor, that's one we certainly would look at. If you go into healthcare, Eli Lilly, which if we had this conversation Wednesday, it looks a little bit different. They had their earnings report both Zepbound and Manjaro just crushed sales estimates, and they beat their earnings, they beat their revenue numbers, and they increased guidance. So Lilly's been on a tear, but we've been steadily adding to that since the drop in mid to early July.
Interesting. Yeah, one of the larger earnings moves that we've seen over the course of this period here. Matt Powers, who is Powers Advisory Group Managing Partner. Matt, good to grab some time with you. Thanks so much.
Yeah, appreciate it. Thanks for having me on.
Definitely. Well, a lot of the wild moves that we saw in markets this week can be attributed to recession fears after that softer than expected jobs report last Friday. Now, a lot of economists and strategists and investors began forecasting that the Fed would cut rates in September and would make a bigger cut than previously anticipated. Your evidence? CME FedWatch probability tool jumping to that 50% basis point marker here. And though our next guest here has a different take, saying the Fed may not cut rates until November. We have Brad Case, who's the Middleburg Community's chief economist, and he's also a former economist for the Federal Reserve. Brad, great to speak with you. Okay, so take us into your calculus here. No cut until November?
I think that's right. First of all, there's no particular reason to cut rates right now. When data really show a softening economy, yes, then there will be a chance to cut rates. But we don't have that kind of data yet. So the people who think that the economy is headed toward recession are guessing that things are going to soften when we just don't have any data suggesting they're softening. You mentioned before how strong consumer spending has been, and that's true. And that is because wages and incomes have continued to increase. Consumers have the money to spend. And until we start to see faltering in income growth or in consumption growth, there's really no reason to think that the economy needs lower interest rates yet.
I mean, aren't we starting to see some of that faltering, though? I mean, it's cracks showing up in the rate at which wages right now are starting to just kind of moderate, and then additionally on the categories where consumers are spending. So it feels like the pressure is there and getting larger, especially as the economists that we've spoken with, I'll reference Dana Peterson, the chief economist over at the Conference Board, saying that this is a battle-weary consumer at this juncture.
I'm not seeing that. You know, the data that are useful for making forecasts about macroeconomic conditions are based on surveys, and you're going to have month-to-month bumps in the data. And so what you're looking for is a sustained weakness. So, for example, the last employment report was weaker than expected. We've seen that several times before, a one-month employment report that was weaker than expected, followed by other employment reports that were not weak. And so I think before we start to take data like that as a sign of actual weakness throughout the economy, we need to see some sustained weakness in those indicators, and we need to see it across a bunch of indicators. Remember that a recession doesn't mean that one part of the economy is weak. A recession means a sustained, strong weakness throughout the economy, both geographically across the country and throughout many or most sectors of the economy. We just don't see that.
What happens if we don't get a rate cut in September, which the CME FedWatch probability, we've seen that already jump, not even just to the point where it's a 25 basis point cut, but to a 50 basis point cut?
Yeah, I think I use that tool. It's a very, very useful tool. But it is based on investment activities by people who have important reasons for hoping for a cut in interest rates. It's not an infallible tool. No single rule is infallible. And so what you have to do is look at a broad range of indicators. I use 8 to 10 indicators, and I look for multi-month trends in them. My recession probability forecasting model has increased in probability, but only to 41%. So the probability of recession has increased, or the probability of recession over the next year has increased, but it hasn't become very strong. I think what's likely to happen is that between now and November, there will be enough data that suggests that the Fed should not continue to keep rates high, and because of that, in November they will start to reduce rates. That may happen in time for the September meeting, but I don't see any sign that it will.
Okay, so let's pivot this to something that you and I talk about quite frequently, Brad, and that is housing and the housing market. What happens to the housing market if we don't see the initial cut that perhaps signals what the rest of the policy pathway could look like?
Well, if you look at residential construction, what we've seen over the last few months is a softening in the amount of residential construction, whether it's housing permits or starts or completions. But you have to recognize that that's coming from an elevated level. There was a demand surge in housing in 2020 and 2021, and that was caused by individual behavior, people wanting to go out and get their own housing. And in response to that demand surge, there was a supply response, a very strong one, and that is tapering off. So just as when we look at the unemployment rate, we've seen the unemployment rate go up, but it's going up from an extraordinarily low level. Just the same way in the housing market, we see starts come down and activity come down, but it's coming down from an extraordinarily high level. So what you want in your economy is you want the entire economy to be moderate. And so we're going from a situation where the economy was too hot to one where it is moderating to a sustainable level. And that's a good thing.
Brad, thanks so much for taking the time here with us. Appreciate you presenting this perspective. We'll have to check back in and see what takes place after September.
I will look forward to it.
Certainly. Brad Case, Middleburg Community's Chief Economist. Thanks so much. All right, everyone, we've got all your markets action straight ahead, plus more on how you can build and grow your own investments. You're watching Yahoo Finance. We've got some good news for home buyers and home owners. Mortgage rates have fallen to the lowest level in more than a year, raising hopes for relief in the housing market. Yahoo Finance's Danny Romero has more on why mortgage rates will probably keep falling before the central bank is set to cut interest rates starting next month. Danny, what do we know?
Brad, finally relief. There's hope in the housing market. Mortgage rates dropped to the lowest level in more than a year. Freddie Mac reported that the average rate on a 30-year fixed mortgage rate dropped to 6.47% from 6.73% last week. Now, the drop in mortgage rates comes as investors have ramped up their bets that the Fed will cut interest rates starting next month. Now, remember, mortgage rates aren't directly tied to the Fed's moves, but they tend to loosely follow the yield on the benchmark 10-year Treasury note, which moves up and down based on the expectations for the economy. Long-term bond yields have fallen this month, which has in turn pushed mortgage rates lower. Now, this could be an opportunity for potential home buyers to come off the sidelines. We've already seen homeowners refinance their existing loans as rates have eased. Now, applications to refinance a home rose 16% last week from the prior week, Mortgage Bankers Association reported. Now, industry experts are expecting that mortgage rates will continue to move lower as bond traders have already priced in a rate cut. But any further drop will likely be limited until there's more certainty on the timing and the size of any initial Fed movement. Brad?
Danny, thanks so much. Tracking the data, continuing to evaluate what it means for the housing market. We appreciate it. Yahoo Finance's own Danny Romero. It's been a volatile week for the markets here. And if you're a student learning finance, your professors might be telling you not to let your emotions get the best of your long-term investments. To discuss what he's teaching his students, let's bring in Peter Ricchiuti, who is the Tulane University Freeman School of Business finance professor. Great to have you here with us. So, I mean, what do you tell your students even during a week like this?
Thanks, Brad. You know, one of the things we talk about is just to avoid the noise. That's the biggest thing. We're long-term investors, and we're mainly value buyers. So, and one of the things we try to push is that if a company does well, the business does well, the stock price will eventually follow. What I do every semester is, and we've been doing this for 30 years, I take 100 students each semester. I divide them up into teams of 5, and each team is responsible for writing an investment research report with models and everything else on a smaller company in the Gulf South. And these are not penny stocks. They're between maybe 100 million and 2 billion. And we've been really enjoy it. It's we've sent 1,100 students from the program to Wall Street, and of course that's your end goal.
Certainly. So with this in mind, I mean, what is the type of risk propensity you've seen students, especially generation over generation, right, change their thesis, change their strategy around how they want to be investors?
Well, one of the things about this generation, they're much smarter than us, I think. Maybe not you, but smarter than I was at that age. And but they've been through a very odd time. They're the gamification of the markets. They've been through the meme stocks and the day trading and Bitcoin and everything else. And so it's when we take them into the class, we're doing a very different analysis because we fly them out to spend the day with the CEO and the CFO. We've had the best site visits in the free world. We've taken helicopters to offshore oil rigs. We've been to steel mills, chicken processing plants. So they see them as real companies, and they meet the real people that are running these companies. One of the things we make them do on the cover page is to come up with a 12-month target price, which they are incredulous about. I had one student tell me, he said, 12 months? He said, that's like 3 girlfriends from now. So I said, I don't know about your personal life, Jonathan, but I need a number on the cover page. So different kind of investing. And I think we really, I think we get to them too.
All right, we might need to have a talk with Jonathan, but outside of that, I mean, we're seeing more technology layered into how everyone is able to invest, and you're actually looking at artificial intelligence and potentially how that could even change the way that students learn how to trade and the role of AI in trading. What is your estimation or, as you look out into the future, what is your anticipation of how much artificial intelligence will be leveraged into investment strategies?
Well, one thing, very few people agree on this, but I think there's never been a better time to be an individual investor. You know, I've been in this business for 45 years. Commissions have dropped to zero. Information is so easy to get a hold of, and that's really what it is. And by the way, we're looking at applied AI. We're not investing in AI companies. We tend to invest in a lot of meat and potato type companies. But what impact is it going to have on the companies? And one of the general things we believe is going to help earnings. And if you help earnings, you're eventually going to help stock prices.
And so just lastly, while we have you here, I mean, you're taking a look at, and the students have really kind of been able to take this opportunity and try to figure out if it's something that they want to do full time. What do you hear from students about the existing financial services industry that are wanting to enter into it and also want to kind of figure out, all right, is this pathway for me? What are students saying about that pathway right now?
Yeah, that's great question, Brad, because the bulk of them really want to go into the investment field, mainly New York, investment banking, although we've sent them all over the country. And one of the things they're hesitant about, or I tell them war stories at least, is just what the hours look like for somebody 22 to 26 getting in the investment business. It's pretty brutal. And the ones that don't mind that go into it. Others maybe want to find a different role other than investment banking.
Peter Ricciuti, who is the Tulane University Freeman School of Business Finance professor. Thanks so much for taking the time here. Best of luck to you and the students this year as well.
Appreciate it. Thanks, Brad.
Thanks. Coming up, an investor's guide to artificial intelligence will break down how big of an impact AI plays in education and your personal finances. That's next. As the new academic year starts, there are growing concerns among educators about how students are using AI-driven technologies in classrooms. And ChatGPT is particularly popular among students. According to a study conducted by higher education research group Intelligent.com, more than 1/3 of college students have used ChatGPT in the last year to assist them with their schoolwork. For more on AI in education, I'm joined by Richard Culata, who is the CEO of the International Society for Technology in Education. I mean, maybe it's just not branded well enough or hadn't been branded well enough, because when you say Copilot, you're like, okay, that's passable. But when it's ChatGPT, you're like, nah, it's gotta be, there's gotta be something bad at play here. So what are the pros and cons that we're gonna see play out this school year with new advancements in generative AI?
Yeah, first of all, this is going to be a very exciting year when it comes to AI. Last year you could kind of get away with still exploring, still questioning whether AI is going to really matter. This year, there's no question. If you're in education, we got to be teaching with AI, but more important than that, we got to be teaching about AI. That's the big thing, right? We have to make sure that we are preparing young people that are in our classrooms today to thrive in a world where they're going to be expected to work on teams where not all members of their team are human. And we have to teach them those AI skills now so that they can be prepared for that world.
And so with that in mind, what are some of the top skills that students can learn to perhaps perfect over time by the integration and working in tandem with technology that can help kind of advance their classroom experience while not sacrificing, doing the work that a lot of us did over the past decades and centuries even?
Sure. Well, first of all, it's important to know what the work is that's important for them to do. We did a lot of work in schools that really wasn't a good use of our time, right? Let's be clear about that.
Yeah.
And so teasing out, what are those skills that are uniquely human skills? What are skills that humans should always be better at? And then really double down on those. Things like judgment, things like discernment, things like creativity. AI is phenomenally good at brainstorming, far better at brainstorming than humans, by the way, right? But AI is actually not very good at choosing the best option. That's something that humans do well if they have the context, right? If they have enough background to understand which of the options to choose. So those are the types of skills we need to be talking about. We also need to help make sure students understand what AI really is. Right? AI isn't magic. Magic is mysterious and uncontrollable. AI is neither of those things. They need to understand how AI generates its answers. They need to understand what are the factors that come into play when answers from AI can be really valuable and when they need to be questioned. Those are all the AI skills that we have to be building in students now while they're in school.
All right, time for me to trademark, I guess, some of my AI prompts. Richard, as we're thinking about the top use cases here, what are the top use cases for students deploying or using generative AI?
Yeah, I mean, there's so many. One of the things that's great about AI is it does a very good job of giving feedback, right? Humans, students, adults even, it's hard for us to take feedback on our work from another human. It just, it's tough. It's a lot easier to take that from AI. So if I say, here's something I've been working on, AI, tell me what are the 5 problems with this argument that I've created. If somebody were to poke a hole in what I've written, what would they say were the problems with my thinking, right? That's a really good way to use AI for feedback. Brainstorming, I already mentioned. Using AI as a tool to help you brainstorm multiple options. Great option there. One more that I think is particularly important, especially given the context of this show, is helping to synthesize large amounts of information. AI is very good at being able to take lots of information and boiling it down in a really meaningful way, which can be helpful in a space like finance, where it can be overwhelming the amount of information that's coming at students.
Certainly. And then on the other side of this, we got to think about the teachers. How can teachers, professors leverage generative AI, artificial intelligence tools that might be made more available to them now in order to cut down on some of their menial tasks as well?
Oh, sure. Look, one of the things, and I used to be a teacher. There are some great things about being a teacher, and there's a lot of tasks, labor, busy work, whatever you want to call it, that is not me spending time with students. And that's really what a teacher should be able to do. And so anytime we can use AI to help take some of those tasks off of educators to allow them to spend more time with students, that's awesome. But again, that means we got to train educators, whether they're K-12 teachers, whether they're faculty members at university. We have to teach them how to use AI effectively. How do you use it to help save you time? How do you use it in ways that can, speed up even generating assessments, generating content, reviewing content, tailoring content. Look, one of the most exciting things that I think AI can do is help educators customize learning for the needs of each student. When you're in a class of 30, 50, 150, if it's a university, students, you're not getting a tailored experience. You're not getting a custom learning experience. But AI actually gives the ability for a faculty member, for a teacher, to customize content even when they have a large number of students. But you have to prepare them for how to do that. We need way more teacher training, way more professional development around effective use of AI. And that's a lot of what we do. My nonprofit organization, the International Society for Technology in Education, provides a lot of professional development experiences for teachers, for higher ed faculty, so they can use AI in ways that really help transform learning and not just replace the human elements with machine elements.
Yeah, some of the modern technology to keep students and teachers up to speed. And you're not wrong at all, Richard. All it takes is one gander or one walk into the first lecture class and lecture hall to know, oh man, this is not personalized at all. Richard Culata, who is the CEO of International Society for Technology and Education. Rich, thanks so much for taking the time.
Thanks. Good to talk to you, Brad.
Likewise. Hey, sticking with artificial intelligence, AI plays a key role in nearly every industry, and personal finance is no exception. Investors are turning to AI to help them reach their retirement goals, but there are risks involved here. Yahoo Finance senior columnist Carrie Hannon has the details on some of these risks for us. Carrie, break them down for us.
Hi, Brad. So great to be here. And this is really a fun topic because I talk a lot about financial literacy and how people are just sort of frozen when they start thinking about what to do about saving for retirement. Just personal finance in general, they just kind of are like deer in the headlights. And often when you say, oh, you should talk to a financial advisor, women in particular, I'm not trying to slam women on this, but it's true, are afraid that they're going to ask dumb questions. And nobody wants to waste their time answering these dumb questions. So here's the thing about AI. You can ask as many dumb questions as you would like, and nobody is going to judge you. I've had some fun playing around with various ones, and like ChatGPT, I asked, what is a target date fund? And I'll tell you what, it gave me some great information of what a target date fund was. And it also said, this might not be just exactly right for you, and you should talk to a financial advisor. Yay, good. Secondly, I said, how much should I have invested in stocks when I said my age? And it broke it down for me. Hey, here are the considerations. You should think about, your risk tolerance and how healthy you are and, all these things. And again, it said you should consult a financial advisor. So I think this was really important. The final thing I think I said is, when should I take Social Security? And I was really surprised at how great the breakdown was of what my choices might be. And again, said, go one step further. Don't rely on what I've just told you here with AI. So, Brad, this is great stuff. So it's not specific recommendations. You can ask dumb questions. It's a good starting point for financial education. It's not going to pick all those investments that you need. And so I say, you guys still have a person on your team. You need somebody to keep you accountable, to help you push past the inertia and actually make a move, to invest, to stay invested, to do, take action to control your financial future. And so I love AI as really a place to get started, but I still say get that advisor to hold your hand, talk about your dreams, bring that emotion into it. That's what it's all about.
Yeah, I'm just glad that AI does not yet kick back that eye roll emoji when I do ask a dumb question. Carrie, thanks so much. Appreciate it.
You're welcome.
Much more on wealth after the break. You're watching Yahoo Finance.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
we're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
As many people's summer breaks start wrapping up in the next few weeks, we wanted to check and see how consumers have been spending their money over the last few months and what it could tell us about the state of the economy. For more insight, let's welcome in Aaron Levin, who is the Bank of America President of Preferred Banking here. Aaron, great to have you with us. So, I mean, in the great battle of goods versus services over the summer, where are consumers leaning in and still spending?
Yeah, thanks, Brad. Great to be here. So our Bank of America Institute just put out a great report on the consumer. And I think the good news here in the headline is that the consumer is still strong. They are still spending. Credit and debit spend is up about 2.5% year over year and 40% over pre-pandemic. And to answer your question, the real spending is going on the service side, the entertainment side. So, of course, you've got the Paris Olympics, a lot of people visiting there. You've got Taylor Swift, concerts around Europe. So that's obviously a place people are spending. But even here domestically, restaurants, movie theaters, concerts, all those kinds of services and entertainment is really the bulk of where the spending is going right now.
It's so interesting, Aaron. The earnings that we've heard over the course of this week, some of the major booking companies, whether that be Expedia or whether that be Airbnb as well, they are talking about some of these shrinking of lead times that they're seeing, last minute trips and growth in those last minute trips. What does that tell you about how judicious the consumer is being about the trips that they are taking?
Yeah. Look, I think the key is that the consumers still feel very good, and this is really tied to wage growth and unemployment. And despite a little bit of an uptick in the unemployment, a little bit of a slowing of the job growth, still people feel very confident in the jobs and in their wages. And so they're allowing themselves to say, hey, I do want to get away for the summer. I want to take that extra trip. And they're going ahead and booking it. So I think it's more the comfort level and the fact that there still is spending. I think another important data point, customers still have about 15% more in their deposit accounts than they did pre-pandemic. Now that's come down from about 40% more 24 months ago, but there's still a bit of cushion. So I think that's what's allowing that more spontaneous trip, people still feeling comfortable to go ahead and spend some money and enjoy themselves a little bit this summer.
Do you anticipate a surge in rewards utilization as consumers are looking for ways to offset some of the trips that they still are looking to take?
Yeah, rewards are such a critical component of spending and of card spending. Obviously, we have a great program called Preferred Rewards where we have 11 million customers that take advantage of it. And it's really critical because every dollar a client spends, they get some back. That takes the overall cost down a little bit. And that's a huge benefit. It also drives spending on restaurants and all the other entertainment stuff. So, rewards is a huge part of what kind of fuels spending and fuels people's comfort level in spending as they think about their budgets and knowing that they do get some money back with every dollar they spend.
Aaron, Bank of America has seen 23% asset growth in both their Merrill Edge self-directed and Merrill guided investing platforms over the past year. What do you think are some of the reasons why clients have been investing at this high volume?
Yeah, so we're excited that the growth has continued really for the last 5, 6, 7 years. We're nearing our $500 billion mark here as part of the Merrill Edge platform. I think, again, the idea is that consumers are doing two things. While they are spending, they still are looking at how to invest for the future. And obviously, our client base is more on a long-term investment strategy, thinking about how to save for retirement, thinking about saving for their children's education, all the critical kind of life priorities as opposed to quick hits in and out of the market. So we see the investing that's coming in is going into thinking about more long-term planning, which is really how we try to help them and educate them on how to best think about investing over the long term.
Certainly. Just lastly, while we have you here, I mean, if you were to look at the historical kind of growth of active versus passive investment, where do you think we stand right now?
Yeah, I think that the key is many clients like to go self-directed and have a kind of their own personal active strategy, given the breadth of information education that's available. But growing is this use of digital advisors as well. And our Merrill Guide Investing is getting a lot of growth where that's portfolios that are identified and selective and is a bit more passive. So I think you really see a combination of both. And I think what's great for the typical investor now is the range of choices and that you have the ability to select, how do you want to invest? Do you want to do it yourself all the way up to, working with an advisor, and certainly in our business, our Merrill Lynch advisors, our private bank. So the choice is great, and clients will really choose depending on what they're looking to do and their time frame to kind of use different alternatives on how to invest.
Aaron Levine, who is the Bank of America president of Preferred Banking. Aaron, great to grab some time with you.
Appreciate it, Brad. Thanks very much.
Certainly. We've got much more on wealth after the break. You're watching Yahoo Finance.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
Markets nearing the end of its most volatile week of 2024. Investors keeping an eye on what could cause stocks to tumble again at a moment's notice. And one of those catalysts appears to be the U.S. presidential election. For more on how to play the markets ahead of a busy November, we've got Tony Zapparo, who is the EquitySet CEO, joining us here in studio. Good to see you once again here, Tony.
Great to see you.
And so, we're a couple months off.
Yes.
But political talk, campaigning, ramping up fast and furious. You've got one former president saying that he should have an eye into what the Fed is doing, and all of this is going to lead into November, which has already been looked at by many CEOs as what's going to be a very vitriolic election season. What are the best way that investors can stay a step ahead of the campaign talk, rhetoric, and debates even?
Definitely. I think there's a couple variables in terms of definitely recession, market softening, right? That's a big one. And I think that could overshadow the election. But if we're looking directly on themes and kind of motifs we can pull out of elections, I think you look for the overlap, the Venn diagram of what is to avoid or consider in either candidate's case. And so when you look at policies, I think a big thing, you look at domestic, right? And whether it's production, manufacturing, selling, and you look at innovation. And I think you take those and you can kind of sprinkle it through any sector you want to look for good finds, right? Or finds that may be positioned poorly, right? Based on what the policy comes to be.
Does this mean picking individual winners and losers, or are you looking across sector and saying it's better to hold the basket?
I think it's picking individual winners and losers, right? Diversifying a bit, picking a couple, right? And not just putting all your eggs in one basket there. But then it's also going across sector with those individual, right, picks that you do. While certain sectors, right, might be a little bit more exposed, right? Consumer discretionary, some of those names, a little bit of a mixed bag. Risk reward, right, is up there in number versus when you look at consumer staples, right, you can pick maybe a little bit less volatile names.
So let's go into some of those sectors that we had just mentioned for our viewers there. And let's start with energy there. Who are some of the winners, losers that you're keeping tabs on?
So, of course, traditional oil, right? If you look at Harris and renewability and crackdown, right, it doesn't necessarily look good for traditional oil versus, right, Trump, obviously renewable camp, traditional oil. And so that's where I think you go in and you play those two themes I mentioned in the beginning, right, domestic and innovation. And so you can still go into, I believe, big traditional oil companies like Chevron, right, NextEra, Dominion, as long as they're being innovative and have already started the process of renewable energy initiatives, I think you can go there, right? And I think then, of course, EVs, you can dabble a bit, right? And it's all about valuation. Tesla, but at the right number. And so because of all the moves we had, going up near 300, now, sub 200, right? And a lot of these names up 10, 20% in the course of a week. That's where I think you overlay it. And then you avoid the ones that really haven't made a footprint or, again, just aren't really domestically founded.
And then on the other that we were discussing a moment ago, technology in that sector. I mean, a massive pullback over the course of this week that we saw, and some picking and choosing that investors are trying to chart as they decide where it seems like an opportunity to get back in at discount prices, if you will. Not bargain basement, but certainly off of some of the high valuations that we had seen before.
Yeah, and if you would have asked me 3 weeks ago, I would have said, probably don't touch semis at all. But even, right, the moves that we've seen, it's okay, I call it nibbling, right? You can get a little bit, right, because they're not so crazy forward PEs, even active PEs that we're looking at. And so I think technology, the big thing is semis, how does an election impact it? It's really, again, looking at domestic. Most semis have a large exposure to international supply chain production, manufacturing, something. And so that's where I think you look at innovation because the domestic picture isn't as clear. You're not going to get it as, oh, hey, there's these 5 companies I can choose from that are only in the US. That's where I think the Nvidias, right, the AMDs might edge out things like the Intels and the Microns just because they're going to move faster than the others and let that disrupt them less.
I'm looking at some of the earnings reports that we have coming out next week as well, and you've got a lot of consumer discretionary names. When you think about how we should be evaluating that sector, not even just for the next earnings or this current earnings period that they're going to be reporting for, but looking out into the back half of the year as well.
And when you get into the consumer discretionary, that's where I think it's more of a roll of a dice, right? Because I do believe we're softening, right? Not the sky isn't falling, but I think a lot of those names will be taken down. And so I think it's buying into those that are domestic, right, are about home improvement. They might be the Home Depots, the Lowe's, or manufacture and produce more in the U.S., Columbia, right, sportswear, Deckers, Yeti, and staying...
Yeti, interesting.
Yeah.
Okay.
And so staying away from maybe some of the ones that have larger international risks, right? And again, you're looking at almost every apparel manufacturer. Yeah. So despite innovation, right, and things we've talked about in the past of like Lululemon, Under Armour, Nike, Gap, Ralph Lauren, I think you stay away from those, but maybe because the unknown is too great in that market.
What do we expect? And there's always this interesting thought process that investors have to wade through every 4 years when we get into a general election of beyond the themes that we could hear discussed, what the real economy will look and feel like as carried through and correlated to the stock market activity. I mean, what is the typical response that we see after election or post-election? And then what really takes the cake from there in terms of investors' eyes? Because it's really been a market driven by two themes. It's been the Fed, and it's also been generative AI. And it seems like one is fading a little bit, and the Fed is finally getting towards their rate cutting.
And I honestly feel that the election, it will create short-term pops and falls. But what I'm concerned about, or what I'm focused on, is the economy's floating. And I think it's floating, and what hasn't been paid enough attention to is debt levels, health of the consumer. And I think it's very healthy for some and not healthy for a lot. And that's where I think that will take focus. And I think there'll be some cracks and then some breaks in the system over the next year or two, which that's why I'm not focused so heavily on what do I invest in from an election, right, and a policy standpoint, because I'm more worried about the financial stability of credit markets and loans and refinancing, even if they cut 75 basis points in September, right, or something, crazy like that. And so I'm worried about that state of the economy more than the election itself.
Tony, I should say, great to see you. Tony Zaparo, who is the Equity Set CEO, joining us here on set. Let's do a final check of the markets as we're taking a look at the Dow, the S&P 500, and the NASDAQ on the bottom of your screen here. There you're seeing some flat activity for the S&P 500, flat just barely to the upside there. NASDAQ Composite moving lower by about 0.1%. Dow moving lower by about 0.1%. And with the time that I have left for this market check, I want to give a great send-off to our own line producer, Mackenzie. You have absolutely crushed it year over year, up like 300,000%. And this team is going to miss you for sure. All the best to you and your fiance, future husband as well. I'm Brad Smith, everyone. That is it for Wealth. Thanks so much for watching. You can tune in 3 p.m. Market Domination with Madison Mills and Josh Lipton comes up at 3 p.m. You don't want to miss that.